How much is this technology for the sake of technology?
I think, you know, it's, to me, when I heard Eberhard make those comments, I thought to myself, boy, Musk is all but certain to weigh in on this on X at some point today. The two of them had a pretty messy falling out going back many years when Eberhard left the company. I think, again, you know, this idea that robo-taxis, these other companies that are pursuing them, aren't offering them to consumers. They have their own fleet. The reason for that is they're really expensive. The hardware that it takes for these to work and work safely really costs quite a bit. And we've seen that, you know, Tesla has taken this approach of, you know, putting hardware into all of its cars, regardless of whether people pay for that technology that they've marketed as full self-driving, and tried to, you know, use, you know, hardware that isn't really enough to get to this point of being able to offer full autonomy, and it just hasn't worked. I mean, it is absolutely the case that the technology has progressed, and some customers are really happy with it, depending on the moment, depending on the day. But it is the case that people still have to keep their eyes on the road and hands on the wheel, according to Tesla.
We just learned this morning, we don't have a settlement amount, but we do know that Tesla did settle that case when it comes to the Apple engineer and that fatal autopilot crash. Craig, what can you tell us, any details behind this settlement?
I was really surprised by it, just in the sense that Musk has, you know, long been a pretty aggressive figure in terms of, you know, his approach to litigation. He's talked about, you know, having a, quote, hardcore department within Tesla to fight lawsuits and even initiate suits. I think in this case, you know, before this settlement, there was, you know, some comments that engineers made that were sort of troubling if you're, you know, a fan of Tesla and an admirer of the company and of Musk. And the fact that this did manage to generate negative publicity for months in the lead up to this settlement, you know, really at the 11th hour before this came to trial, was damaging to Tesla. And, you know, it is also not a story that's over. There are more of these cases that are coming, brought by folks who have been involved in crashes using autopilot, and you know, more to come there.
Always drama around this name. Craig, appreciate the updates, Craig Trudell. Only two stocks can say they've had a worse year than Boeing year to date, and one of them's Tesla, which says a lot. That stock is down by more than 30%, even with a 5% pop yesterday. Greg Vanier of AGF is going to join us next from New York City. This is Bloomberg.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them. Did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger. But drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that. We'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the fire line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
Intervention from the BOJ. Governor Wader keeping his options open in comments to Parliament, saying, quote, "We have to consider reducing the degree of monetary easing if the underlying price trend rises with our outlook." The question is if that is actually happening right now.
Well, people are expecting the Bank of Japan to actually upgrade their inflation forecasts. What I find actually more interesting is that any intervention hinges completely on the CPI number tomorrow in the United States, and that essentially their hands are going to be tied by what happens to monetary policy in the United States. My guess is, and honestly, who knows about BOJ guessing, it always is wrong, but my guess is they're waiting to see what comes out of that meeting, what comes out of the CPI report that we get, to really understand just how much they can intervene with a currency that really stands to weaken substantially if we get an oversized surprise.
Bingo. Let's turn to the south side. Steve England of Standard Chartered said almost exactly the same thing. What is the most likely timing for intervention? England has said this: they will most likely wait for CPI on April 10th. Tomorrow, a hot CPI print would mean fighting market fundamentals. That's a difficult intervention proposition, and that's the problem they've got. Words won't buy you much if you're going into an upside surprise on CPI and a much, much stronger dollar off the back of it.
If you get that kind of price action, can we start to price in another potential incremental hike or less easing by the Bank of Japan just because they don't have a lot of other tools to fight this?
Or maybe even a lot more jawboning. Let's get to some of that. Some verbal intervention from Janet Yellen, the Treasury Secretary, over the last few days. One more warning to China as she wraps up her trip abroad. Yellen threatening to sanction any bank who helps Russia expand its war effort against Ukraine. It comes just as Russia's Foreign Minister Sergei Lavrov arrives in Beijing to meet with Chinese officials. Anne-Marie, were they listening?
Well, for a while, we've seen the Biden administration try to crack down on these individuals, firms worldwide that are helping Russia attain a lot of these materials. Yellen really wanted to hone in on the fact that any material that can be used as dual use, that the military can use, that's what the Biden administration is going to go after. But it's awkward when Sergei Lavrov is also arriving in Beijing at the same exact time. And we do know that trade continues to flourish between Russia and China.
Well, this is the difficult thing. How do you parse out good trade from bad trade? And this is something that Janet Yellen was talking about. China and Russia do a lot of trade. Much of it's non-problematic. But if it helps the war effort, well, then it's problematic. Well, anything that gives them money, you could argue, fuels the effort to fight in Ukraine. So it becomes a very kind of fuzzy line that we're getting drawn here.
This is just like the BOJ story. Words, policy. Lots of words from the administration on China. Want to see the policy. And when you talk to people, we had this conversation the last day or so, most people assume you're not going to see a policy shift until you get closer to the election. You might have to wait until as late as, say, September, October time.
We're learning, though, what some of those policies might be. We're learning that tariffs are probably on the table, or a likelihood, and we're also learning that now sanctions, and I believe this is the first time that they've publicly talked about sanctioning Chinese banks and Chinese companies that do business directly with Russia that they view as helping that effort. So we're getting a sense of what some of the levers might be that they might pull to.
And then, of course, there's the strategic presidential election reserve that I think is on tap before the election.
That's the latest from Janet Yellen. Let's turn to our last story. Lawmakers returning to Capitol Hill today. Pressure growing for House Speaker Mike Johnson to pass aid for Israel and Ukraine, but with a slim majority to do so. Greg Valier of AGF Investments saying this: Johnson is increasingly on thin ice. He probably has enough votes from Democrats to pass Ukraine aid, which would infuriate rebel Marjorie Taylor Greene. She only needs a vote or two to boot him. Greg, let's go straight to that story. Thanks for catching up with us. Is the Congresswoman willing to do that?
I think so. She's put out the word in the last few days that she would wait and see what happens on the Ukraine legislation. But if Mike Johnson keeps his word and does send a bill to the floor of the House, I think she could erupt. It's not out of the question that by early May, we'd be once again talking about a new Speaker of the House.
Greg, at the same time, we have the British Foreign Secretary David Cameron at Florida, meeting with former President Donald Trump to try to pressure Republicans to help Johnson get this Ukraine aid through. Is the international pressure potentially going to be enough to get some of these Republicans to back off?
Yeah, they're going to need concessions. It's going to have to probably be a loan, not an outright, aid. It's probably going to have to unfreeze some Russian assets, but give them to Ukraine. There will be other provisions in the bill that could delay it by a few weeks. But yes, the international community is adamant that we need this. And I think the key factor here is that Johnson himself realizes we need this bill.
The other potential provision will be a ban on new LNG export applications, which we had the Biden administration come out and put a pause on. Republicans want to stop that. If that bill gets to the House and they amend this supplemental, can it pass the Senate?
Not sure. The Senate has become a wild card, as you know, Anne-Marie, and they may not go along with something like that. That's going to be a close call.
I wanted to bring up what Mitch McConnell said yesterday, and this has to do with another issue that Congress is dealing with, and this is the TikTok bill. He said it's a matter that deserves Congress's attention, and he says he is going to support it, and he thinks it makes sense in a bipartisan way. Do you see the TikTok bill coming to fruition before the November election?
Yes, I do. I don't think in the next few weeks they've got to talk about Ukraine, and there's a growing debate, an intense debate on abortion. But I think by the fall, you will see a TikTok bill.
Okay, so last night I was thinking about this as I was thinking about Congress, and I think I'd like to run for Congress because they work 1 out of every 2.5 days. They are coming back from recess today. They go back on recess in less than 2 weeks. And I'm thinking to myself, you know, how much are they actually working at a time where we're talking about aid to Ukraine? We're talking about a deficit. We are. They're not. How much are they actually working to get stuff done?
You know, when there's gridlock, Lisa, that means they do less harm. So I don't lose sleep like you over this. If they don't do much, that's great. I would just add real quickly, the big story overnight is abortion. And I think that for all the people denigrate Donald Trump, he was shrewd here. He basically is going to let the states handle it. He infuriated the far right wing, which is maybe not a bad thing for Trump. So I would say on this, he's shown that he can be a clever politician. Who knew?
Well, let's go there. This idea that it's okay or not a bad thing for him to lose some of the far right. Is that really true, given the fact that that's been a base, that he's been selling Bibles, that he's been trying to really get out there, and this is actually one of the cores of the turnout that typically has come out for him?
Well, look who came out overnight infuriated by this Biden decision. Lindsey Graham, well, he gets booed when he makes a speech in South Carolina. Mike Pence, you know, he was at 4%, 5% during the primaries. So if Pence and Lindsey Graham are upset about this, and the mainstream of the Republican Party, the more moderate Republicans like the proposal, that's pretty shrewd on Donald Trump's part.
Hey, Greg, appreciate the update. Greg Vandier there of HF Investments. Want to get to something you said. I think it's absolutely critical. To see the British foreign minister go down to Florida and meet with the former president to try and pass policy in Congress is just absolutely amazing to me. And maybe we've got used to this, I don't know, but I find that absolutely stunning.
You haven't seen it, I think, in this way, so outright and obvious. This is an in-person meeting, but it just goes to show how much hold Trump has in the Republican Party. And if the international community, the likes of David Cameron, are struggling to want to see the United States come to the table and get Ukraine aid done, they know they're going to have to get Donald Trump involved.
And this isn't because they necessarily are betting on whether he's going to win the election. It's because he is the one that's pulling the strings right now in Congress. That is the perceived kind of view out there, which raises this question about how different this moment is. That you have a candidate who is a former president, who's running for office, who's pulling the strings in one house, in one half of Congress.
Yeah, this is not about the next Congress, the next government. This is about this one.
Correct.
Right now, it's just absolutely amazing. Let's get you an update on stories elsewhere. Let's get to your Bloomberg brief. We can do that with Danny Berger. Hey, Danny.
Hey, John. The Bank of Japan will likely consider raising its inflation forecast when it meets later this month. That's according to Bloomberg sources. The central bank is expected to discuss revising its projection for consumer prices higher, excluding fresh food from the current 2.4% for the fiscal year. Surprisingly strong results from annual wage negotiations are behind that move, but the BOJ is still widely expected to keep its policy steady at the meeting on April 26th. President Joe Biden has outlined his plans to forgive student loans while visiting the key swing state of Wisconsin. Biden's Plan B would see loans reduced for millions or wiped out for millions of Americans, excluding those whose debt exceeds their original principal amount or who attended universities that offered little career benefits. The proposal is expected to face challenges in court that could stretch into the next year. The records keep coming for women's college basketball. Sunday's championship game between South Carolina and Iowa drew a new record audience of 18.7 million viewers. ESPN saying that the numbers peaked around 24 million viewers in the second half. Those numbers are expected to rise when Nielsen numbers are released later today. It ended up becoming the most viewed basketball game, pro or college, since the men's championship 5 years ago. That's your Bloomberg Brief, John.
Danny, thank you. I don't think you can overstate what she has done for women's sports in the last month. I really don't think you can.
I think that that's a very wise way of taking this story, since I was informed that we're not allowed to talk about this at Purdue.
We can't talk about the men's game.
So we're not going to talk about that.
We'll
just talk about the women and how incredible her performance really has been.
It's just phenomenal. Think about what this could do for the future now. What kind of foundations this is setting for women's basketball outside of college.
it's not just simply the other choice that's sort of there as some sort of messaging. It's actually the main story, and that's wonderful.
I loved when the South Carolina coach came down right immediately after the game and said, "I'm so happy we won, but thank you, Caitlin Clark, for bringing all this enthusiasm to this sport."
Phenomenal. Up next on this program, the case for 3 rate cuts.
You should probably take the committee and the chair at face value. I think their best guess right now is still 3 cuts this year. And of course, the data can go one way or another, but that's the base case.
That conversation up next.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Lisa, so excited about Delta earnings. That as you come out this morning, they come out tomorrow morning. Is that how excited you are about Delta earnings?
We're having a special.
You want them like the day ahead?
I know. I want to
before
preview.
CPI.
Well, I've never seen her more excited about anything more than auctions
My
except
bad.
Delta.
I'm sorry. I just was. It's a view on the consumer.
How much have you spent on Delta Airlines?
I don't want to talk about that.
Yeah,
Okay,
I think that's more to the point. That's the story at the moment. Equity futures on the S&P 500 negative here by 0.1%. Yields a little bit lower by 2 or 3 basis points. 439.17. It's a quiet start to the week. It picks up tomorrow morning when you get Delta earnings. CPI a little bit later on. Under surveillance this morning, the case for 3 rate cuts.
I think you have enough data in hand right now to justify the first rate cut, maybe not a whole string of rate cuts, but you could certainly justify the first rate cut. You should probably take the committee and the chair at face value. I think their best guess right now is still 3 cuts this year, and of course, the data can go one way or another, but that's the base case.
Here's the latest. Investors looking ahead to tomorrow's CPI report for signs of inflation cooling after a bumpy start to the year. Shannon Grine of Wells Fargo writing this: March CPI should be telling of whether the pickup in inflation in January and February was a function of early year noise or if inflation's journey back to the Fed's target has been drawn out materially. We expect headline CPI to show that progress is slowing. Overall price growth has at least temporarily gone into reverse. Shannon joins us now for more. Shannon, let's get into that. The details tomorrow morning. What specifically you and the team are going to be looking for?
Yeah, so I think the importance here is really the composition of inflation going forward. So what's driving this stickier point of inflation? Was it seasonals at the start of the year, or are we seeing a renewed acceleration in that core services component, particularly when you strip out shelter? So the composition is really key for tomorrow's report and then going forward. Obviously, we got stuck in terms of those headline and core annual rates, but if the composition shows a bit more of a shift, I think the Fed will be moving in the right direction in terms of sustained progress on inflation. Tomorrow's report, as we mentioned in our note, I think is going to be a bit of both, where you do see a bit more of a stickier trend in place with core inflation probably coming in close to its fourth quarter average in terms of growth rates. But further out, we still look for progress in terms of inflation later this year.
Shannon, I'd love your view on what we heard from Jack Manley yesterday of JP Morgan, where he said that on the margins at this point, given where rates are, they're almost inflationary, based on what they do to the housing market, what they do to certain kinds of insurance premiums, and that inflation will only get back down to that 2% level when the Fed cuts rates. Do you agree?
So I think you're dealing with an economy that definitely has some inflationary sources at the root of it. So when we think about what's still being pretty inflationary, is coming from a demand side. So when we think about the consumer, time and time again, we've somewhat underestimated the strength of this consumer and just this resiliency of this economy. So we saw this through the jobs data last week, with employers adding over 300,000 jobs in March. For consumer spending in February, consumers spent at the fastest pace since the summer of 2021 in terms of services consumption. So I think some of that is still feeding back into the services side and is a problem or a question for the Fed if it causes, that sticky inflation coming from services. So I think we're in an economy that still has a lot of inflationary pressure. If you have a consumer at the end of the day, whether that's through housing or other assets, if they're continuing to spend at an elevated clip, it gives businesses less reason to ease prices. So I think the Fed is still looking for a slower period of growth to be consistent with a sustained trajectory towards 2% inflation. So I do agree there's still some inflation pressure that I think needs to be stomped out before the Fed is confident that they're on that sustained trajectory towards 2% at an annual rate.
Something that we've been grappling with over the past few weeks is just where commodities fit into the inflation story, given the fact that we have seen sort of the resurrection of goods inflation, and we see commodities, not just oil, but also copper and silver and gold and everything else under the sun. So this raises this question, is it disinflationary? Does it dampen growth? Or is it actually a sign of just how much demand there is on a global level at this point, as we do see a really benign backdrop?
Yeah, I sort of think it's a bit of both. I think it speaks to this robust demand profile. The economy remains really sturdy in terms of demand. So I think you're seeing that flow through to some of these commodity prices. But I do think it's inflationary at the end of the day. So for tomorrow's release, we are expecting the headline to absorb some of that higher gasoline and food prices over the past month. And then, that's why we really look at that core goods component. So when you strip out some of these commodity effects, we are looking for continued or a return to deflation from a core goods perspective, so in tomorrow's release. And I do think the normalization we've had in supply chains to date does suggest we'll continue to get some deflation from the core goods component, just not as much as we have over the past year, which really raises the bar for that services side of inflation going forward, which is really why I think the composition of inflation is more important from here, just as we truly get back down towards that 2% target as far as the Fed is concerned.
How much does the Brent crude rally, the commodities all across the board, metals, precious metals, how much does that rally unnerve the Fed?
I think they're paying attention to it, right? It's inflationary. If we think back to just U.S. macro basics, it's obviously a challenge for consumers who rely on gasoline, who look at that price on a daily basis. So if you look at the prices of food and gasoline generally, those price levels are still significantly higher than where we were, obviously pre-COVID or pre this inflation spike. And they have outpaced broader inflation and wages generally. So I think that really gets to this consumer mindset of why you're continuing to spend, but you're not really optimistic or have high sentiment measures at this point. So I think the Fed is paying attention to these figures. Obviously, they feed back into the headline inflation rate, which is the target of the Fed. But I do think they can look past some of this spike in gasoline as well, as they try to focus on that services side of inflation and really making sure that that's on a sustained trajectory lower, because it does tend to be stickier than some of these volatile commodity components. So they're paying attention to it, but I think it's still important to consider.
Shannon, do you think we are, and maybe even the Fed is, overstating their influence on the recent trend in inflation over the last year or so?
I think the Fed is in a position where they're trying to, navigate this inflationary environment where they've seen sustained progress. We obviously got some better, higher than expected data at the start of the year. I think the Fed want to ease policy as long as inflation continues to come down, but they're in a very much data dependent mode. And until they see these inflation prints on a sustained trajectory lower, I don't anticipate that they'll begin to ease. So I do think this data dependency is somewhat getting underestimated by the market in the beginning of the year. Obviously, the inflation data surprised to the upside, and you're seeing the market readjust. But I do ultimately believe that the Fed will act as the data warrants this year.
One thing that we have to ask, because we're going to be focusing on this throughout the next couple of months, is the deficit and how that features into the Fed's calculus. They will say not at all. They will say that they don't care. And yet we start looking at some of the deficit projections, and they're creeping substantially higher as a result of where yields are. How much does that factor in, given the fact that this is becoming a real hangover and a self-fulfilling prophecy, potentially within the yield space, with yields rising even higher, if the Fed doesn't step in?
So, when to use your words, when we say that the Fed doesn't care about it or they're not focused on it, I think they pay attention to all these factors as they translate to yields and the inflation data generally, but they're not going to act to counteract some of those measures. So even when we think about the election later this year, I don't think the presidential election prevents the Fed from beginning an easing cycle, but I think the way that they communicate it becomes more tricky. So to the extent that the higher deficit and those projections around that do cause yields to move higher, that could add some financial tightness in the economy to an extent and cause the Fed to begin to ease earlier. But I do think it ultimately comes down to this inflation data. And even though the balance of risks has somewhat shifted this year compared to last year, where the Fed might not be as willing to push the economy into a modest contraction to get inflation to 2%, right, since we're closer compared to those 5+ handles that we experienced on inflation last year, I do think they're still focused on inflation. And given how tight the labor market is currently, they have cover to really focus on getting us closer to target before they begin that easing cycle. So it factors in. It's just not, I think, a direct reason for them to start an easing cycle, for instance.
That CPI report just around the corner. Shannon, thank you. Shannon Grind there of Wells Fargo, going into CPI tomorrow morning, 8:30 Eastern time. We've had a few bumps in the road. How many more bumps in a road do we need before they are no longer called bumps at the Federal Reserve?
I guess it depends on who you ask. I was really hoping that maybe we'd hear something different from Austin Goolsbee yesterday of the Chicago Fed. He's been the resident dove, saying basically, let's get on it. Let's cut rates. Guess what? He still can consist of the resident dove, who didn't really seem to...
He's still talking about high rates, maybe pushing up unemployment, isn't he?
Well, here's the issue, and this is the reason why yesterday I said I share the difficulty. I understand. This morning, we did get a bit of data, not Delta earnings, which are tomorrow, which I got wrong, but we got small business optimism that came in at the lowest level going back 11 years, more than 11 years. So here we are talking to large cap investors in U.S. stocks saying, oh my goodness, this is going to go to 6,100 potentially, or just keep on rallying. Small businesses are feeling the effects of high inflation, high wages, issues with all sorts of potential demand or price sensitivities. It's a different scenario, and it's the reason why people are trying to understand what's going on.
I totally agree. We'll get to what's going on in just a moment. Equity futures on the S&P negative by, let's call it 0.1%. Let's set up the next hour on Bloomberg Surveillance. The brilliant Mohammed Al-Erin of Queen's College, Cambridge, joining us around the table here in New York. We'll catch up with Stuart Kaiser of Citi, Megan Draper of Barclays, and a whole lot more in the next hour. Bramo, I know there's a few stats that Kaiser had over the weekend on this equity market that you want to get into. 100%.
He's got some interesting perspective, but the last time we saw a 2% drawdown.
Amazing. He's counting the days, right?
Well, yeah, and it's something like, past time was February of 2023. Crazy.
Amazing. Equity futures then, a little bit softer. Bond yields a little bit lower. Down 3, 438.97. The third hour of Bloomberg Surveillance. Up next.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
So So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. But we do a breakthrough. We look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
It was going to keep World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
The longer the Fed keeps policy higher, I think that there's a potential that that's going to feed through into the broader economy.
The longer that we're at these interest rates, I don't think it's going to be as much of a problem for markets to digest.
And as the interest rate environment gets better this year, all of these things are going to be tailwinds for those laggards of 2023.
By staying tighter for longer, that's probably building more credibility to the market.
It's going to be a delicate balancing act, but markets are not questioning the Fed, at least not yet.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
I should correct myself. It's the second hour of Bloomberg Surveillance that begins right now, not the third. And
Let's get to the weekend.
Quiet start to the week that I'm trying to sort of press fast forward on. Equity futures on the S&P 500 negative by 0.04%. Live from New York City this morning. Good morning, good morning. It's a very quiet start to the week. Monday went basically nowhere. Tuesday, essentially unchanged. Going into Wednesday, that's when the fireworks start at 8:30 Eastern time.
And perhaps before we start earnings, actually are tomorrow, not today, we are going to be looking at CPI, how much that's really going to change the narrative in terms of the bump in the road becoming the new transitory, as Priya Misra said, or potentially highlighting the disinflationary narrative that so many economists and Fed officials are buying into. I really find it fascinating that inline is the new beat. And we keep talking about this, but an inline report is going to be just enough to kick off this market and keep it going for a while longer.
And an upside surprise does what? This is going to be interesting, that relationship, that evolving relationship through the year between bond yields and what's happened with equities, because so far in 2024, essentially the consensus view has been dead wrong. Look at all the upgrades we're seeing to the equity market, massive upgrades. You're seeing a 1,000-point swing in some of these calls, and not to pick on Chris Harvey of Wells Fargo, but to pick on Chris Harvey of Wells Fargo, to go from 46.25 to 55.35. 4 months into the year is quite a massive lift to your equity market outlook, given that we were all predicating this rally on lower interest rates and interest rate cuts from the Federal Reserve, and that's not what's happening. We're pushing out the timing and reducing the magnitude, the amount of rate cuts that are going to happen in 24, and yet a lot of people are still very bullish on this stock market.
There's an existential comment underpinning that, which is that essentially, if this economy can keep chugging along with rates at this level, maybe they're not all that restrictive, and maybe we're not going to go down all that much. And if that's the case, what needs to reset, or are we just in a new normal where this is actually acceptable? That is the question that we need to hear from the Fed, because at this point, that's underpinning a lot of the optimism that yes, this looks high, but it's not as restrictive as people thought, because you can still see economic growth.
Steve Rasciuto just now publishing, talking about the vulnerability in the market, because he says the domestic financial markets are fully priced for this perfection, for these 3 Fed rate cuts, which we've seen the market just continuously push this down the timeline.
I've seen that phrase a million times since the end of October. November, price for perfection, equity market kept rallying. January, price for perfection, equity market kept rallying. Listen to this now. Morgan Stanley's Mike Wilson, no landing. SocGen, recession delayed indefinitely. That's how much things have changed in 3 months.
And people talk about whether this is the immigration story, whether this is just simply fiscal stimulus, it's still sloshing around, whether this is just basically that there was that much more dynamism in the economy. But it raises the question, everyone's ready to buy a dip that is not happening. And that's why I'm curious about Stuart Kaiser's metric, where we haven't seen a down 2% day since February of 2023.
The dips are just very, very small, negative 0.05% on equity futures right now on the S&P 500. Here's a snapshot of the market for you. In the bond market, yields 439.17, down 2 basis points, called it 3 basis points lower after kissing, making new highs for the year on a 2-year, 10-year, 30-year in yesterday's session. In the FX market, 108.70 on the euro, and crude a little higher by 0.2%, $86.61. Coming up this hour, we'll catch up with Mohammed Al-Erin of Queen's College, Cambridge, looking ahead to CPI data. Citi Stuart Kaiser on why he says momentum is back in charge, and Megan Draper of Barclays as Treasury yields trade near 4-month highs. We begin with our top story, investors on inflation watch. US March CPI data out tomorrow, followed by PPI data on Thursday. The former Fed President Jim Bullard still calling for 3 rate cuts this year, saying, quote, at this point, you should probably take the committee and the chair at face value. Their best case right now is still 3 cuts this year. That's the base case. Mohammed Al-Erin of Queen's College, Cambridge joins us around the table here in New York. Mohammed, good morning to you.
Good morning, John.
Let's get into that line from Mr. Bullard. He's left the FOMC, so he can speak a little bit more openly, as you can as well. Your base case is still 2. When do we start to see another bump in the road, together with all the other bumps in the road, no longer be called bumps in the road on the FOMC?
I think it's going to take time. I think Chair Powell has made it very clear that he's willing to look through these bumps. To use his phrase, the inflation story hasn't changed, so they will need overwhelming evidence that it is more than a bump in order for them to change their views.
You think they're too sensitive to recent data and maybe not being strategic enough. What do you mean by that?
So I think if you look forward, and you talked about in the last hour about business confidence, if you look forward, there's reasons to believe that this economy may slow. So if you're setting policy not according to what has happened, but according to the lags with which the policy operate, you would be more dovish than you would be otherwise. If, however, you focus exclusively on the data, you will end up being too hawkish.
You talk about small business optimism. Let's go there. It came in at the lowest level since December of 2012. Sometimes it's hard to know how to read some of these gauges, especially because we get people on all the time saying they're all broken. How important is this in contrast with all of the bullishness and the MOMO and the FOMO and the WOWO that we keep hearing?
This is really important. The big mistake that was made in 2021 when people embrace the transitory narrative was they didn't listen to the companies. And the companies were clearly saying, we have inflationary pressures in the pipeline, we have pricing power, we're going to pass on that imported inflation, if you like, that was coming in. This time around, listen to the earnings call, and they are worried about the outlook for the rest of the year. So I do think you need to listen to them, because often the aggregate data doesn't capture what businesses are feeling on the ground.
When you say businesses, though, we're going to hear from JP Morgan, and my guess is that Jamie Dimon was raising some concerns more generally in sort of a broad macro level. When he talks about his own bank, my suspicion is that he's, doing quite well, and that the bank is probably issuing another record quarter in one way or another. How much does it matter that the pain is being felt in a small subsection of companies that are smaller, more leveraged to high rates, and frankly, more leverage to a consumer that would likely be price sensitive?
It matters because they're also employees. Everybody should read Jamie's letter. Okay, I've read it. I've gone through the 61 pages. There's so much content there. You should read it. And he has this situation whereby he's worried about the world. He says, looking forward, here are all the things I'm worried about: sticky inflation, slowing economy, a completely changing global economy. But his bank is extremely well positioned to take advantage of this world. Why? Because they've got a very solid balance sheet and they dominate in so many different areas. So I do think this duality can exist at JP Morgan, but it cannot exist economy-wide.
You believe that the Fed should cut rates, even if you're not seeing necessarily a commensurate slowdown. Do you think that the risk of a reacceleration in inflation is overstated by some?
So I don't know how often I've said it here and elsewhere. Inflation will be sticky. Inflation will be absolutely sticky. We're going to get stuck at around 2.5% to 3%. And I do think that that actually warrants, over the long term, the Fed rethinking its inflation target. It won't do it now, but it may well tolerate it. And you've heard what's going on. Service inflation hasn't come down quickly enough. And guess what? Goods deflation is going to stop. So yes, inflation will be sticky, but that shouldn't stop the Fed, because the 2% inflation target is too tight for a global economy going through a major rewiring. And that, again, is well discussed in Jamie Dimon's letter about this rewiring that's happening in this global economy.
We're at risk of this conversation becoming very circular, but let's run with it. If they begin to show signs of tolerating higher inflation, and you've basically told us that you believe that maybe we're starting to see that shift based on the news conference we had with Chairman Powell only a few weeks ago. If we believe to see signs of that higher tolerance, doesn't that make it even harder to get inflation down? Doesn't inflation become even stickier? Doesn't inflation expectations become, that word they like to use, de-anchored? Isn't that the risk here?
So there's a difference between inflation expectations adjusting to 2.5% to 3%, and already if you look at the 10-year break-even, we're at 2.4. So we're not that far already, and inflation expectation being de-anchored. There's a fundamental difference between the two. I do believe that you can do it without de-anchoring inflation expectations.
Whatever happens, this equity market's rallying. That seems to be the case at the moment. So we've had bank failures, higher rates, geopolitical problems, and we've had two hot wars. You've got sticky inflation, got people talking about changing inflation targets, and yet equity markets are still absolutely ripping. Why do you think, and what do you think underpins our ability to brush aside issue after issue in this stock market?
I think it boils down to three things. One top-down, one bottom-up, and one behavioral. Top-down is that economic activity has surprised around the world, has been better, including in Europe. Europe didn't fall into a deep recession. The US economic exceptionalism continues day after day. Two, on the top-down is policy. People truly believe, and you heard it again this morning on your show in the first hour. You heard it on your show.
Not the second.
Not the second.
This is the second, okay.
It is a snoozy week, as you said in the beginning. But you've heard it. People believe the Fed put is there. And then you have a bottom-up, very strong, disruptive technology coming along that can fundamentally increase productivity. I believe that. Generative AI, but life sciences. And you have more spending coming on healthcare, on defense. And then finally, you have the behavioral aspect. I don't know what MOMO stands for, but certainly FOMO. And that is why you don't get these people react really quickly. Put these three things together, it will power this market for much longer than people expect.
I won't ask you to translate whoa either. I will ask you to respond to this quote from Chris Harvey at Wells Fargo. You touched on this issue that we're discussing right now in your piece in the FT earlier this week. Chris Harvey's put out this quote: the bull market, AI's secular growth story, and index concentration have shifted investors' attention away from traditional valuation measures. Are we saying that valuation metrics don't matter in a market driven by themes like this one?
Yeah, I think they've been suspended for a while. And we've seen it before. It happened in tech, it happened for Amazon, where people basically suspend their conventional wisdom about this. I think what I was trying to say in my piece is look longer term. And you've got to factor in that the world is changing in a way that the markets right now are not even looking at. You know, we used to have three really important tenets. One, at the domestic level, these are economies that will deregulate and liberalize, and they will maintain fiscal discipline. Now we are in economies that have industrial policy and deficits that are out of control. On the global side was ever closer globalization, ever closer integration of trade and investment. Now we have weaponization of trade and investment, and we have fragmentation. And then on the market side, it was the maturation of markets, the maturation of instruments. Okay. Now, we're having something completely different. We're having FOMO, we're having liquid instruments being created for illiquid tools. So fundamentally, if you look at 3 to 5 years, this is changing. But right now, the short-term factors are so strong that people should maintain this. And you had earlier on the show someone releasing a momentum vehicle. And what does that do? We overshoot on the way up and we overshoot on the way down.
MOMO stands for more momentum, just briefly. Just before we move on, I do want to get a sense, are you concerned about the auctions at all? Do you watch the auctions? Do you care about them? Do you think that they actually could potentially influence markets?
I do, and I do because your discussion about gold earlier, it's not just about inflation, it's also about central banks around the world looking for alternatives to the dollar. So yes, we are going to, in October, the discussion was who was going to buy this massive issuance that's happening. And I think you've got to keep an eye on all 3 auctions this week.
Pause. We got time. We can talk about this. You went there. Gold. You believe that underpinning the all-time highs is maybe central banks trying to diversify away from dollar-denominated assets? Is that what you think is going on?
The data's out. Central bank buying is very active. China in particular has been adding month after month after month. Look, if you are outside the US and you've witnessed the weaponization of the dollar, you will ask yourself, what can I do at the margin? You can't do anything major, but you can start doing things at the margin. And I think central banks' buying of gold is indicative of this.
Okay, is that because of the State Department or the Treasury? Is that because of issuance or sanctions? Which one is it?
It's mainly because of sanctions, but also issuance plays a role.
Do you think that now that almost this cat is out of the bag of what the United States is willing to do, this means long-term de-dollarization?
So de-dollarization is a very strong term because you cannot replace the dollar with something else. But the image you should have is people building little pipes around the dollar. And we've seen it not only in how they hold their reserves, but also in trade. People have been shocked how Russia has been able to trade as much as it has while being out of SWIFT. How has it done that? It has built a very clunky, inefficient system, but that it works, that involves 4 currencies. And never anywhere near the dollar. So what you're seeing are little pipes being built around the system. They're not going to fundamentally change the role of the dollar, but they're going to make the dollar less dominant going forward.
Is this next week's FT column?
No.
Just figuring that out? No?
No,
Okay.
no, you have to ask me on a Friday.
Okay. Mohammed is going to be sticking with us. Equities right now just turning positive by almost 1/10%. Let's get you to the Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Senate Minority Leader Mitch McConnell has voiced his support for a bill that would require TikTok's parent company to sell the app or face a ban. The Senate says requiring ByteDance to divest from TikTok lands squarely within established constitutional precedent, and it deserves urgent attention from Congress. The UConn Huskies are back atop the college basketball world. UConn defeated Purdue in the NCAA National Championship game by a score of 75-60 to win their 2nd straight title. The Huskies cap off a dominant season where they only lost 3 games. They've become the first team to win back-to-back titles since 2007. Now UConn's record is 6-0 in national championship games going back to 1999. The U.S. is going to have to wait another 21 years to witness what most of us, maybe some of us, saw yesterday. Millions from Texas to Maine were dazzled by a total solar eclipse. Just about everyone in North America got to see at least part of the sun blocked out. The path of totality for this eclipse crossed through several major cities, including Dallas, Indianapolis, Cleveland, Buffalo, New York. An estimated 44 million people live on the track saw the moon pass in front of the sun for a full 4 minutes and 28 seconds. That's your Bloomberg Brief, John.
One of those great moments to bring humanity together. Danny, thank you. Wasn't it? Just beautiful. Great.
It was awesome.
Just wonderful.
You didn't watch it.
It's nice to be a piece of that. Up next on the program, all eyes on CPI.
Inflation is probably the most important thing to be paying attention to. I don't think any individual inflation report sways the Fed's narrative, but inflation will kind of further this story that the economy is doing pretty well.
Just touched by that, you know. The whole world stops, pauses.
I thought it was wonderful.
For a common cause.
All these families.
Says the man who didn't watch it, and I even brought you the equipment.
How do you know that I didn't watch it?
But you didn't watch it with those glasses because Manna stole them.
No, but I was outside with the people, just taking in the moment.
You didn't see the moment, though.
As the traffic stopped and it got a little bit darker.
With the people?
Yeah, you know, the people.
Which people?
The common lab.
In the local community. That's next. It's not. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Earnings season is coming.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now. We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been? Better than what the street was expecting. Bang in line with estimates.
We will have full and instant analysis.
It all starts Friday on Bloomberg. Context changes everything.
That's how quiet this market is. I've never seen people so excited about the eclipse. Equity futures on the S&P 500, positive 0.06%. Yields lower by 2 or 3 basis points, 439.37. Under surveillance this morning, all eyes on CPI.
Inflation is probably the most important thing to be paying attention to. At least that's how the market's going to interpret it. I don't think any individual inflation report sways the Fed's narrative, but inflation will kind of further this story that the economy is doing pretty well. As the interest rate environment gets better this year, as inflation continues to sort of normalize this year, all of these things are going to be tailwinds for those laggards of 2023.
Here's the latest. Stocks pausing ahead of inflation data. Bloomberg Economics expecting core CPI to rise 3.7% year over year. That would be the smallest gain since April 2021. City Stuart Kaiser writing this, CPI should prolong a solid macro setup that allowed a low volatility 6-month equity rally. We remain positive on US equity risk reward after very strong labor data, and we're encouraged by markets rallying from early quarter wobbles. Stuart, I'm pleased to say, is with us around the table. Stu, good morning to you.
Good morning. How are you?
Your stat, love it. Bramo mentioned it yesterday. Let's just begin there. 282 days. I imagine it's 283 now since the last 2% pullback, the 12th longest streak since 1928. What can you learn from a low vol rally like this one over the last few months?
I mean, I think what you've learned is just when the economic data is doing what it's doing, the markets are going to sort of behave accordingly. You know, I know there's a lot of concern out there, valuation's high, volatility's low, and that means we need to sell off. But I think the fact is you've had very strong growth. Inflation's easing, not as fast as you might like. And equity markets are responding by low realized volatility, and that's kind of the situation we're in right now.
Couldn't tomorrow's data change that story?
It could. I think you would need a pretty significantly high print. I mean, it's going to have to round to 0.4 at least, or you're going to have internals to the inflation data that are particularly kind of troublesome. If you print down the consensus number, I think consensus is 29 basis points. City US Econ is 33 basis points. I think if you print a number like that, equities are going to respond modestly positive. It's honestly not as big an event this month, it doesn't feel like, in terms of client conversations.
Which is really compelling given the fact that this seems like it could be another bump in the road that leads to this question of whether we're not getting it right. How far could momentum go if this is an inline print? We're just talking about Chris Harvey upgrading his forecast to 5,500 plus. We were talking earlier about the idea with Chris Verone of 6,100. Are you getting on that train?
I don't know if I'm on the 6,100 train quite yet, but look, I think coming into the year, we basically said if you avoid a recession and the Fed starts doing insurance cuts, you know, the top end of your outlook has to be quite high. And I think if in that type of situation, yeah, you're talking high 5,000s to low 6,000s. I'm not saying we're going to get there, but that is where the sort of bogey is going to be if they're doing insurance cuts into a strong economy. I'd be surprised if they did it, but if they do, they're going to support equity risk.
Which raises this question that Mohammed was talking about, which is that momentum feeds on itself. We talk about new vehicles being created to funnel more money into momentum trades, and that things that overshoot on the way up overshoot on the way down. Do we have a sense of where we are in that? Is that sort of, are we halfway through the overshoot? Are we just beginning it?
I mean, I don't know if we're overshooting. I mean, I think in my view, the stuff that is momentum leadership should be momentum leadership. These were the stocks last year that were the small group of companies that were generating earnings growth. So they outperformed, and that kind of becomes momentum. The momentum trade right now is a little bit tricky just because the long end of it is very tech heavy.
The short end of momentum, most people trade that long short, is utilities and real estate and more kind of defensive parts of the market. So it's hard to get momentum to have a negative return in a rising market because you have very low beta kind of living in the short leg. You really need small cap to pick it up because small cap is something that people are short and underweight. So small cap for us has been, incredibly kind of important risk metric for the markets as well as the momentum trade.
So staying on momentum, there's suddenly a lot more interest on commodities and the sort of price increases we're seeing, significant and broadening. How does that feed into inflation story, in particular both the first round and second round effects?
Look, it's very important, Mohammed. I would say, we would kind of categorize in three spots. You have the copper part. Copper is very growth sensitive, as you know. I think equity markets would read higher copper prices probably as net positive because it suggests a growth impulse. Gold, I'm not going to get too much into. Gold bugs have a lot of reason that they want to own gold. There's a big central bank story there, so it's a little hard to dissect what's exactly going on in the gold market. And then you've got oil. And oil is, I think, the one that if it continues to rally is the most troublesome from an equity perspective. There's obviously a big geopolitical aspect to that as well. I think most investors in the U.S. said, unless oil starts to move, I'm going to kind of ignore what's going on in the Middle East or at least compartmentalize it. So the move we got in oil, I think, was very telling from an inflation perspective as well as from a geopolitical perspective. So, yeah, we are worried about the surge in commodity prices, but I think from equities, it's the oil part that would concern us.
Can we just sit on that for a beat longer? Does the crude move just sort of address itself? Hits growth, crude rolls over. Is that the way you would view things as a policymaker, just from the outside looking in?
Oil's been a tricky trade the last 12 or 18 months. I mean, if you told me you were going to have, Russia-Ukraine war, you were going to have war in the Middle East, you're going to have OPEC cutting production, I think most folks would have expected oil to be able to maintain a higher price for a more significant period of time. The fact is the U.S. is producing a ton of oil. There's probably a lot of discounted oil being bled out of Russia to other markets. So it's a little harder to read that. But, yeah, I mean, the Fed is obviously not going to ignore the price of oil, but yeah, the reason they look at core inflation is because they assume that type of stuff is sort of transitory and self-correcting. So I think they will try to ignore it. The fact is, other than immediately after Russia invading Ukraine, you haven't sustained a $90 oil price since about 2014. So it's a little bit of a prove it story for us as well. Like oil needs to show us that it can stay at those levels before we're going to kind of really change policy based on it. I think.
Sticking there for now, Brent crude, Lisa, $90.55.
I love this idea. He's like, I'm not a gold bug, Stuart. You're talking about this, and Mohammed earlier was saying, well, maybe you're a little bit of a gold bug. Are you a gold bug?
No, but I do think it has information. Gold has information content.
Chris Verona of Strategas earlier this morning called silver devil's metal, didn't he?
So I think
see that?
He also
the devil's
commented
metal.
on having gotten it wrong a bunch of times. So I think that might be a idiosyncratic moniker.
Silver up again today by 0.5%. Likewise on gold, a series of all-time highs in precious metals for gold over the last few weeks. Stu, thank you. Good to see you. Thank you, sir. Coming up, Megan Graper of Barclays with a yield on the US 10-year near 2024 highs. That conversation just around the corner, live from New York City. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Equities on the S&P 500 positive here by 0.1%. On the Nasdaq, little bit of a bounce, positive by 0.15%. On the Russell, the small caps outperforming just a touch, up by 1/4%. In the bond market, had new highs for 2024 in yesterday's session. We're backing away from them this morning. We're down 2 basis points to 476.99 on a 2-year. On a 10-year, down 3 basis points to 439.17. And I'm told there are some important auctions coming up through the next couple of days.
Yeah, I mean, this is the reason why we're really focused on the supply of debt that's coming out of this country. We've got a 3-year note auction that's coming today at 1 p.m. We've got 10-year tomorrow, and we've got one of a 30-year denomination on Thursday. To me, it'll be interesting to see the 10-year in particular. Those have been messy, and could that change the narrative where suddenly people start to worry about that, especially if you see yields rise and gold's gains at the same time?
Given how much everyone seemed to like bonds to start the year, at 4%, shouldn't they love them at 440? I'm surprised by how few people have come on the programme over the last few weeks with this backup in yields who aren't banging a table saying, buy bonds here, buy bonds, because they were doing that at the start of 24.
That's what's happened every single time, because people don't understand where the price-sensitive buyer is going to step in, how many price-insensitive buyers are still buying treasuries, and that's the reason why the auctions are important, because we get a sense of just how price-insensitive people are in terms of coming in and buying up some of the supply.
Mohammed, you've mentioned Andrew Balls over at PIMCO before, and your recent column as well, I think you did the same thing. He's talking about taking duration risk elsewhere, outside of the United States, because of some of the dynamics we've been talking about through the last 30 minutes or so. Is that the kind of thing that resonates with you? Does that make sense?
Yeah, I mean, he's absolutely right. If you look at what has happened to the Treasury bond differential, that's still trading at 200 basis points, and it could go it could go higher. You've got two things that are not happening here: slower growth momentum and actually sharper disinflation in Europe than here. And I suspect that we may well see the ECB cut as often, if not more, than the Fed, which was unimaginable a few months ago.
Jeff Yu of BNY Mellon said that this meeting was a live meeting. Doesn't think they're going to cut on Thursday, but thinks it's actually a live meeting. Would you go that far?
Yeah, I think they're going to signal quite strongly that June is when they're going to cut. Something that the Fed will not do.
Let's turn to the FX market and talk about the euro. And we can talk about the difference between the Federal Reserve and the ECB. Euro dollar right now is at 108.67. Mohammed, this came from Eric Nilsson over at UniCredit. We shared this quote on the program yesterday. I'd like to repeat it and get your response to it. The massive contrast, the huge difference we're seeing between the European Central Bank, the way they're communicating, and the Federal Reserve. This is what he said. The Fed says it doesn't know when exactly it will start the rate cut cycle, but it sends a clear signal about the expected pace of cuts once it starts and a view on the expected endpoint. In contrast, the ECB has all but pre-announced the first rate cut more than 2 to 3 months ahead of the formal decision, but insists the path thereafter remains virtually invisible. How important are those two distinctions right now, the differences between the ECB and the Federal Reserve?
I mean, it's important and it's counterintuitive. So why is it important? Because I think it is having a huge impact on relative pricing between Europe and the US. And you do see that in the bond market, and you see it in the currency market.
Well, which raises this question about parity. right? And whether you actually think that that's a possibility the way that Jeff Yu does, given that if the ECB does signal with more definitiveness, that could really lead to a devaluation.
Yeah, it's a possibility. Is it a probability? I'm not so sure, but it is a possibility. But the other thing why it's counterintuitive is because of the signaling that has happened from Fed Chair Powell and ECB President Lagarde. Fed Chair Powell says he doesn't know where our start is, where the neutral interest rate is. If you don't know where it is, it's very hard to figure out where you're going.
Yeah, they still offer a view on it in the dot plot.
They offer a view on it, but when he's asked, where is it, he distanced himself from the dot plot correctly, saying, look, that's just a collective view of 19 people. But when asked directly in Stanford, he said, I don't know where it is. And yet, we know where we're going to end up, which is a little bit counterintuitive.
Is there a simpler answer? It's higher than it was before.
Yeah, that's the absolutely correct answer.
Is it much higher?
I think it's significantly higher.
What number would be significantly higher?
Nearer to 3.5% than anywhere that we've heard about.
Closer to 4 than 3?
Yeah, I think Bill Dudley is absolutely correct when he says about 100 basis points higher than where the dot plot suggests we may end up.
When we start to close that gap, perhaps even later this year, what will force them to close that gap? Do you suspect that at the moment that's just a conversation they're refusing to engage in because there's bigger conversations to have at the moment?
Yes.
Does that make sense?
You can hide behind data dependency for quite a long time, and that's what they're doing right now. But the problem with that, I keep on stressing, data dependency is a backward-looking concept, and policy needs to be forward-looking. So at some point, it becomes a real problem.
We look forward to an ECB decision later this week. The Federal Reserve coming up a little bit later in the next month as well. Under surveillance this morning, some top stories for you. JP Morgan's Marko Kolanovic seeing opportunities in utilities and real estate shares, the two worst performing groups in the S&P so far this year. The recommendations coming despite the warnings since last year that investors should stay away from equities more broadly. We go into the note from Marko yesterday. Front and centre for me at least, Lisa, away from this, commodities. Overweighting commodities, sticking with commodities because of inflation risk, sticking with us through the rest of this year.
And the fact that they see that coming from the demand side. What I find interesting, though, is how those two ideas are paired together. The utilities and real estate call is tied somewhat to this idea that yields are going to stay here and go lower. So if you have a higher inflation backdrop with respect to commodities, but you also are betting that yields are going to go substantially lower, it speaks to this sort of Goldilocks that's getting baked in increasingly to a lot of valuations.
He's overweight, as well as HSBC maintaining their overweight. The question I continue to have for commodities is it just temporary? Is this going to be through the summer, or can we actually see this gear up to the year end? And when you look at call options, they're reaching their peak in the summer for Brent crude, 125, 135. People are actually putting on how high this market could go.
This is the quote from Marko. We are not out of the woods yet on inflation, and the current backdrop of above-trend growth raises the risk that inflation will re-emerge as a problem for both central banks and for markets as well. Mohammed, we were just having a conversation with Stuart Kaiser about how sustainable $90 Brent crude is. As you look at the economy, outside the United States, let's look at the global economy. How sustainable do you think it is?
So I think in pure growth terms, it can be absorbed. In inflation terms is where I'm not so sure. I don't know how this will impact wage behavior. And the lesson we got from 2021 is do not ignore the service sector, do not ignore wages, because they react to price increases that you may think are transitory, but people do drive. It does impact how they think about their standards of living. So that's the big uncertainty.
Inflation expectations could climb again?
And wage behavior may change again.
Interesting. One for the Europeans to watch too. I want to turn to our next story. Tesla's ex-CEO saying it's a shame Musk may be scrapping the company's low-cost EV. Martin Eberhard, who worked at Tesla until 2007, telling Bloomberg bringing down the price of EVs is the key to their adoption. Eberhard also saying a low-cost car makes more sense than a gigantic truck. I think we can all agree with him on that. AMH, where is this one going? Because yesterday it was all about robo-taxis and that stock was up by something like 5%.
Well, when Reuters originally reported this, Elon Musk came out with a pretty vague denial. When the robo-taxi reports are coming out, he had a weird emoji, kind of a smirky emoji on Twitter. When it comes to this low-cost car, it seems that Musk just doesn't want to. If this is the case, they're going to scrap it. He does not want to have that competition with BYD in China, which their low-cost car is, what, less than $10,000.
What struck me about the ex-CEO's comments were this discussion of technology for technology's sake. And it goes to this question of, is Tesla a tech company company or is it a car company? It wants to be a tech company, but increasingly markets are trying to reconcile with the fact that ultimately it is looking a lot more like a car company. And I think that seems to be what Elon Musk is trying to fight and maybe what markets are trying to grapple with.
I think we're trying to reconcile with broken promises. Promise after promise of certain things developing or being developed, certain things being released and then not being released and not being developed, and trying to work out whether this date in August is actually the real deal or not.
Well, I think part of it is there's bad news on Reuters, and then it's, well, look over here, something super exciting coming down the pipeline. It's a little bit of smoke and mirrors.
Well, and also you want to have somebody who is an idea generator. You want somebody who is, sort of in vogue and provocative. But as the CEO of a major company that's already evaluated at a certain level that has to have real kind of pricing and business models, it becomes more challenging.
By the way, it worked. The stock was up by almost 5% in yesterday's session. Elsewhere, markets pricing in 2 Fed rate hikes this year, or rate cuts, but former Fed President Jim Bullard expecting more.
You should probably take the committee and the chair at face value. I think their best guess right now is still 3 cuts this year, and of course, the data can go one way or another, but that's the base case.
Ahmed, that's his base case. Your base case is still 2. Can one number tomorrow change that for you? Can we carry on pushing this issue of maybe 3 cuts down to 2, down to 0, to perhaps nothing for the time being?
That's the direction of travel for the marketplace. I think I'll stick to 2 for a while. And the market is at 60 basis points. So it's between 2 and 3. Whether it's 2 or whether it's 3 is not the big issue. There's a number of economists, however, that suggest that we may get no cuts. Now, that's a different paradigm.
We saw from State Street this morning, they came out with a new projection for a 50 basis point rate cut in June.
Yeah, I don't understand how they came up with that.
Okay, well, what if and then they came on, say, 150 basis points entirely this year
50 by June?
Of rate cuts.
What would need to happen between now and June to get 50?
They think that there has been a sort of weakness under the hood. They say that right now the economy is not as strong as it seems. They point to credit card delinquencies, the cost of credit to small businesses, the small business optimism. Why do you reject that kind of idea?
So I do think the economy is weakening, and that's the point I made earlier. But to get enough weakening to prompt a 50 basis point cut in the Fed, I just don't see it. I do not see it.
If they did, for example, cut for 50 basis points and didn't cut again, and just said that they were done, do you think that that would be appropriate? Because what we've seen is actually markets actually pricing a greater number of cuts in 2025 and 2026, even as we've seen some people move away from rate cuts this year. Do you think that that's the problem with the market pricing right now?
So to be clear, I don't see a 50 basis point cut.
You've been clear, don't
However, if it were to materialize, that would be a massive policy mistake. You would panic the markets. You would create all sorts of dislocations in this marketplace if you suddenly cut by 50 basis points.
I want to ask you about the jobs report we got in terms of immigration. How much are you buying that this is an economy that is just becoming bigger and not tighter?
No, I think it's both on the demand side and the supply side. I do think there's a really good supply side story for the labor market. When you go beyond that, it gets a bit trickier. But for the U.S. domestic labor market, there is a good supply side story, and immigration has something to do with that. But there's also a good demand side story that we're seeing a lot of demand for workers. So net, it equals out. But if we didn't have the good supply story, we would be in a much more difficult place right now.
I still don't understand. I've asked this question a million times, and I'm still not satisfied with the response I've had so far in this program at all. I don't understand how the Federal Reserve can point to the labour market as evidence that they are tight when we all know that the reason why there isn't wage growth is because of this supply side story that everyone is pointing to. And by the way, we used to call this a very different thing. The supply side story has become a rebrand, a more palatable rebrand of what is actually developing right now, which is mass immigration, which is basically weighing on wages. Now, no one wants to talk about it that way, but isn't that what's happening?
Yeah, no, this is a supply side story. Okay, what they point to when they talk about tightness in labor market is the quits rate. They look at a few indicators, but they don't take the holistic view of the marketplace. It is a supply side story on the labor market. We have benefited from enhanced supply. Labor force participation went up by 0.2 percentage points. That's significant.
Can that change in a couple of months in one election?
It could. It could.
Do you want to hinge monetary policy on something that can change in a couple of months in one election?
You've got to conduct monetary policy with what you know and what you expect. If you start being sensitive to political issues, then it becomes really problematic. I mean, if you're sensitive to political issues, you take into account President Trump's promise of a 10% import surcharge.
It's true.
okay, you would have a different view of the world if you took that into account.
Mohammed, you're going to stick with us. Equities right now on the S&P 500 positive by 0.1%. Let's get to the Bloomberg Brief. We can do that with Danny Berger. Hey, Danny.
Hey, John. Pfizer plans to apply for wider approval of its RSV vaccine after new test results. A single dose produced a strong immune response in adults aged 18 to 59 with conditions like asthma, diabetes, and chronic lung disease. RSV is a flu-like illness that affects elderly adults and babies most severely. Blackstone is said to be nearing a take-private deal for cosmetic company L'Occitane. Bloomberg has learned the PE firm may team up with the cosmetic giant's billionaire owner for the buyout. The company has a market value of about $5.6 billion, while the chairman owns more than 70%. GM's Cruise autonomous driving division is set to resume testing its robo-taxi service in Phoenix. Sources tell Bloomberg that safety drivers could be back behind the wheel as early as today. GM had grounded the fleet last year after one of its cars struck and dragged a pedestrian in San Francisco. A Cruise spokesperson says the company, quote, had not set a timeline for deployment. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on this program, bond yields steadying from 2024 highs.
I think it's going to be tricky for yields to continue to rise from here. Now we're in a different environment where the Fed's bias is clearly towards easing.
A conversation up next.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
Let me just start with, this is not the first time we've heard this argument.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Inching just a little bit higher on the S&P 500, positive by 0.06%. In the bond market, yields a little bit lower, down 2 basis points, 439.57. All eyes on crude recently, 86.30, just backing away from the highs going back to October in the commodity market. Under surveillance this morning, bond yields steadying from 2024 highs.
I think it's going to be tricky for yields to continue to rise from here because I see this current environment as being very different than what we saw in the fourth quarter of last year. Now we're in a different environment where the Fed's bias is clearly towards easing. So they've told us that they're thinking about rate cuts sometime in the second half of this year. So that, I think, kind of mechanically puts a cap on how high yields can rise from here on.
Here's the latest. Yields falling after touching year-to-date highs, with the 10-year nearly closing in on 4.5%. Megan Draper of Barclays writing this: the market has moved into higher for longer territory for both rates and Treasury yields. We think that any easing cycle in response to lower inflation should be shallower than priced in, as the US economy is clearly doing fine with higher real rates. Megan Draper joins us now for more. Megan, can we get straight into what this means for credit? Is that problematic for credit, with spreads trading very, very tight over the last few months?
I
think it's actually a net positive with the demand side of the equation that's being really motivated by underlying yields. So if that first cut continues to be elusive, our race strategists are actually of the view that we should see longer yields trend substantially higher from here, not lower. And that in and of itself underpins the bid that we're seeing from an array of global investors that are playing in the credit markets.
As you know, we've had some stunning supply come to this market. It's been taken down really well so far year today. And I was just wondering how many bricks we've removed from that looming maturity wall at the end of this year going into 25. How much smaller is that wall now?
I mean, we certainly haven't lost any steam into the second quarter. I think the theme and what's really the defining force behind investment grade issuance right now is this theme of acceleration. So if you've got funding needs, if you have maturity towers, even into early 2025, we're seeing borrowers pull that forward to take advantage of the technical backdrop. So, you know, I was on the road last week with some of our top bank and corporate clients in Europe, and having surveyed a fairly wide cross-section of both treasurers and CFOs, the average issuer I spoke to was already very deliberately already 2/3 of the way through their full year funding needs, which is pretty astonishing when we're only 3 months into the year. In fact, one client I think was as much as 80% of the way done. So I think it's fair to say pulling forward, tackling those forthcoming maturity walls is well underway and something that's going to continue to fuel activity in the first half.
Megan, I'm struck by the difference between Europe and the U.S., especially in light of this ECB survey that came out that showed demand for corporate loans in the Euro region showing a substantial decline in the first quarter. Is that consistent with what you see and you hear, and how different it is for European borrowers versus U.S. ones?
The landscape has really changed. I think there is an anticipatory factor talking to European corporates in particular who are trying to get ahead of what may be a divergence of central bank policy around the globe going forward. And with that, you're seeing a decent number of non-U.S. domicile companies actually appealing to the dollar market. One, I think to diversify their investor base, but also ensuring that they've opened up sort of multiple funding avenues ahead of any change to sort of that global central bank landscape. So I think you're seeing maturity tower management. I think you're seeing access to long duration, a long duration bid in the dollar market for those borrowers. So there's not any angst there, certainly, but there is sort of preparation happening as we watch this larger subset of non-U.S. based corporates and banks starting to appeal to the dollar market.
Megan, when you look forward, is there a level of U.S. yields lower than where we are now where you start worrying about who's going to buy all this issuance?
You know, the interesting part is in talking to investors, which is sort of regularly on point in terms of where we are forcing the dialogue, it feels like down to 4.5%, you still see a healthy yield-centric bid from Asian investors, from Middle Eastern investors, but also from traditional pension and insurance money. So we've got a ways to go in terms of seeing that bid erode, with the index on the IG side right around 5.5% as we stand this morning.
Megan, what you just are talking about is sort of fascinating, that maybe you're seeing demand come down in places like Europe and other places because a lot of the borrowers are going to the U.S. market to raise money. Is that really what's going on? Is essentially the U.S. is considered the most robust place and the most consistent place to raise cash, and you see that bid, and that's the reason why even foreign borrowers are coming here rather than going to their home markets?
Well, some of this was a bit counterintuitive because you tend to see a rush from non-U.S. based banks in January, and with how functional the European markets were out of the gates in 2024, you actually saw many of those borrowers stay in their home markets for that first bout of issuance. And so as borrowers emerge from blackout, we look at this April, which is largely going to be a bank and finance centric calendar. Corporates are in earnings blackout. It's really about the diversification piece. So if they took advantage of euros in January, making sure they paved the way and re-engaged with investors in the U.S. So that they've mitigated risk as we move forward. I mean, I think everybody is sort of worried about what are the landmines in the second half. It's not wholly obvious right now, I think, with the tone having been really more driven with a bias towards good news for the moment. I think near-term downside risks are noticeably shrinking. So all of this is trying trying to lay the groundwork for volatility ahead, understanding that technicals today are about as good as they could be. They're really priced to perfection.
Since we're price perfection, we keep hearing that over and over again on this program. Megan, since we're talking about issuance, I want to bring up the CBO monthly budget review yesterday. Interest on the public debt rose substantially, increasing $133 billion. How concerning is this? The federal budget yesterday also totaled $1.1 trillion for the first half of the fiscal year. How concerning is this for the second half of the fiscal year?
I'm less concerned about that because I think fundamentals are in very good shape. I mean, the borrowers we're talking to here at Barclays, from a fundamental perspective, are very defensively positioned. In fact, I think many have operated as though a recession has actually already happened. We talked about it for the better part of a year. And so you saw cash on corporate balance sheets having increased meaningfully. Companies pared back their share buyback plans. CapEx growth has slowed. So even if we start to see a departure of that as the baseline as we move later into the year, I don't expect there to be a material reversal of the technicals we're seeing, at least not over the near term.
Hey, Megan, thank you. We've got to leave it there. Megan Graper there, the brilliant Megan Graper of Barclays on the latest in fixed income and credit specifically. With us around the table for some final thoughts is Mohammed Al-Erim. Mohammed, big week ahead. CPI tomorrow morning, got jobless claims and PPI on Thursday, and we've got the bank earnings on Friday. Out of those three big things developing over the next few days, what are you focused on?
CPI and PPI. If you do put the order, I'll put CPI, PPI, and then bank earnings.
Bank earnings after PPI?
Yes.
Why is that?
Because I think we know what we're going to hear from the banks.
Things are good?
Yeah, capital markets activities have picked up. Interest differentials are healthy. So it's PPI and CPI where there's a lot more uncertainty.
What do you think the unknown is currently for those two reads?
I think the unknown is going to be whether goods disinflation persists long enough for service inflation to come down. That's the key issue. If you put me on an island and pick me up, I wish you would, in a year's time, and ask me what's the one set of data I would like to know, I would ask you what's happened to the different components of the CPI.
One thing that people might be confused about, given the fact that you do think that the Fed should cut rates in June and then go twice this year, is that you think that they should adopt something more of an easing policy. You actually disagree with the market longer term that are pricing in a significant number of cuts in 2025 and 2026. Can you talk about the distinction between your view and where the market's at?
Yeah, I mean, my view for why they should ease this year has to do with the economic weakness that's ahead of us. Longer term view, if you look at where I think where our star is, what I think is the right sort of premiums that are attached, then it is very hard to see the Fed cutting much more aggressively from where they may end up this year. Whereas the marketplace assumes they will, and the Fed assumes that they'll cut even more. So, you know, I'm above the market and nowhere near where the Fed thinks they're going to end up with interest rates.
Mohammed, this was great. I think there's more chance of you picking me up and taking me to the island. But that's just my view. I'm sure most people would agree with that.
It's just a common lad.
He's just one of the guys, I know. Working class.
Yeah.
Boy from
Did you say hello to the people downstairs while you were looking at the eclipse?
When we were celebrating the eclipse.
Yes.
Absolutely.
Yeah. And did you wave? Did you give the royal wave?
Yeah,
like that.
Elbow, wrist, wrist.
That.
Oof.
You know, don't move the elbow too much.
You know, he has a castle in his town.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead, the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you think about that?
I can imagine.
Instagram moment with the sunset, to having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
I don't think any individual inflation report sways the Fed's narrative, but inflation will kind of further this story that the economy is doing pretty well.
I don't think that we need these rate cuts. I think the markets have digested these higher interest rates just fine.
The Fed could very well end up not cutting rates this year if the data continues to be strong.
I believe there is really no rush to cut at this point.
The Fed may get that supply side increase and still see inflation slow.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's do this again. The third hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg. Equity futures on the S&P 500, just about positive by 0.1, call it 0.2% higher, after being virtually unchanged on the S&P in yesterday's session. Plenty of commentary out there from the likes of Morgan Stanley, no landing, Evercore, Goldilocks, overextended. Mohammed Al-Arian on the program in the last hour saying maybe there's a slowdown beneath the surface we need to pay a little bit more attention to.
And he pointed to small business optimism. He talked to about the earnings that we have to look at that really does speak to a little bit more concern by executives that are looking at inflation still being sticky, consumers that are starting to push back on pricing, and frankly, them struggling to pay the higher wages and the inflation and generate the revenues to really keep themselves in business.
And consumers struggling with those higher rates as well, Bramo. We talked about this quote from the New York Fed survey that was released yesterday. I think it's worth bringing up again. The so-called perceived probability of missing a minimum debt payment over the next 3 months, that's risen to 12.9% for the month of March. That's the most since the onset of the pandemic. So for a lot of people, these interest rates are a problem.
This is the issue, and we talk, and you put this really well about the immigration and the fact that it's actually keeping wages down when a lot of people need their wages to grow to even keep up with inflation. This really speaks to how there are pockets that are getting very badly hurt by rates where they are. It might not be reflected by the mega caps, and that difference really starting to weigh on certain people's expectations of how far growth can go.
This is why in the jobs market and the jobs report, I was so keyed into the uptick of individuals who are having to go out and get more than one job. It's because they can't afford their bills right now. And if you think you're on payments, whether or not it's autos, mortgages, or just grocery prices, this summer it's going to be gas prices, that is a concern that is under the hood of this stellar top number.
Doesn't that speak to why the president struggled so much in the polls over the last 12 months?
Exactly. It's because inflation hasn't gone away. It's also the perception, the idea that you go into the grocery store and you remember where prices were before the pandemic. Prices are not going down to that level. It's the rate of change that's coming down. And that is something that is very hard politically to communicate.
TK would talk about this a lot. The cumulative inflation of the last 4 years, that's still a bill that people are struggling with.
It's something like 25% for certain things. When you go out to eat, think about how much higher the bill is now. I mean, honestly, feeding a family of 4, for example, just theoretically, when you go out in New York City, costs double what it did 4 years ago, really, at the same places. And there are all these add-ons. But if you think about it from the restaurant's point of view, and I know a restaurant owner, and they have to pay higher wages to their employees, they're paying higher fees for just the upkeep, and even rents are going up. It's a very difficult situation.
When it comes to groceries, I'm glad you brought this up. John Authors this morning has a brilliant chart out. Food fight, presidential food fight. For President Biden, it's the highest level of inflation for food going back to Nixon. This is where politics and where the healthy economy really get difficult ahead of November.
Have you noticed the inverse correlation between services and prices? Have you noticed that sort of price up, service down?
Yeah.
You've witnessed that too?
Yeah.
It's not just a New York thing,
No,
that.
it's not. It's also well, I don't really want to go there, but yeah.
And then they add the service,
Yeah,
anyway.
and then you have to pay the tip at the end, like
No.
the sort of
Well, it's
suggested.
already included.
But they
heavily
included,
suggested.
Heavily suggested. I don't know what to do with that. When you get a coffee and they make it, then I feel like it's important to tip.
Can I just say this? Because I think it's an important change. America's like 20 years behind on fintech. Most people would agree with that statement. When it comes to payments technology, it's just not been adopted here very quickly compared to, say, Asia, Europe, or Latin America for that matter. But now they're starting to bring the machine to the table like they do in the UK. They bring the machine to the table and you swipe your card in person opposite them, and then they turn that tablet round to you whilst you're sitting there at the table, and it says like 20, 25, 30, sort of shaming you into clicking the higher one, 30.
Oh, well, or if you're just even buying something. The more difficult one for me is if you go to a bakery or if you go to just your butcher and you pay for something and then they turn it around and it's suggested tip. What do you tip for? If they just get something from the counter and they give it to you, do you tip for that?
Apparently.
Or do you not? And then do you suggest a tip, and then is it offensive to them? I mean, there are lots of psychological guilt sort of aspects to this transaction.
You get shamed into it, Bramo. I'm a good tipper anyway. I'd like to think I am. I've adopted that sort of American approach to tipping.
It's very American.
I'm aware.
But do you tip for just buying, say, a health bar?
I'll give $1 for something like that to get a coffee or something. That seems to be like baseline.
Yeah.
Does that make sense?
That's exactly.
$1 or something, which works out at about 20%. Depending on where you buy your coffee, based on New York prices.
Exactly.
Okay.
Good job.
Equities right now, thank you, appreciate that. Up by 0.2% on the S&P 500. Stocks with a little bit of a bounce here. In the bond market, yield shaping up as follows. Your 10-year Treasury yield lower by 4 basis points, pulling back from yesterday's highs. We're down to about 437.97. Coming up this hour, JP Morgan's Phil Camporelli on his soft landing outlook. Morgan Stanley's Seth Carpenter looking ahead to inflation data. And Afsan Abeshlos of the Rock Creek Group on the Fed's rate cut path. We'll begin with our top story. Investors in wait-and-see mode ahead of Wednesday's CPI data. JP Morgan's Phil Camporelli saying this: the backdrop of better-than-expected growth, slightly higher inflation, and a commitment to 3 rate cuts are driving our overweight to stocks. Phil, I'm pleased to say, is with us around the table. Phil, let's get to it. You love bonds and stocks. You've loved it all year. Why hasn't this data changed that story for you?
Yeah, so, being an asset allocator over the past couple of years, John, was like trying to see the eclipse yesterday without those special glasses. And now the glasses are on, and we can kind of see this soft landing view play out. And when you say, yes, we love stocks and bonds, I want to be really, really clear about something. This soft landing view that was hope is now reality. Why? Because you have a Federal Reserve that's basically saying this hot inflation number that started the year are bumps in the road, and the story is essentially the same, okay? And at the same time, they took their growth forecast this year from 1.4 to 2.1 and said, we're good on the 3 cuts, okay? So they're easing into strength, which supports the nominal growth view. And then on the bond side, listen, we are not bullish just rates falling or core bonds. What we're saying is we don't have a recession view, and we like credit. And the credit story is not a home run, okay? It's additional yield over our index, which is a form of alpha. And then really big picture things, John, I think the double sevens, the $7 trillion balance sheet that the Fed seems intent to want to keep, and the 7% U.S. deficit, I mean, these are major liquidity things that are pushing the nominal growth view higher.
Okay, a lot to unpack there. Can we start with soft landing?
Let's do it.
What's the definition of a soft landing when you're talking about mega nominal GDP growth and we've got 300 and something thousand in payrolls growth last month? What is
Yeah, so the soft landing view for us, and I'm really happy you asked this because it differs from Goldilocks. People throw this stuff around all the time. So the soft landing view for us is about a 2 to 2.5% GDP growth rate If trend growth in this country is 1.8, that's above trend growth, and inflation probably staying between 2.5% and 3% until the end of this year. And that, what we think, allows the Fed to very slowly and methodically bring rates lower, which is very, very different from where we came into this year when we were all at our New Year's Eve parties talking about 8 rate cuts. And now we have only 60 basis points.
What kind of party's that?
Same parties you go to, John.
Wild. They're not sound like a party.
Same parties you go to. So now we're only talking about 60 basis points of cuts. That's a very, very different environment. That's soft landing. That's not Goldilocks. And that then leads us back to the large cap versus small cap trade. And it leads us to the quality earnings story and the free cash flow story.
Let's talk about the gold part of the Goldilocks. You like that?
Yeah, I did.
Okay,
like
but moving on. Okay, it's the same kind of party that you go to where you're talking about 8 rate cuts. But there is this question here about if you don't like bonds, and credit isn't a home run, if gold starts to make it into that 60-40 kind of ballast in a more meaningful way.
Not right now for us, Lisa. So gold is not the commodity or commodity allocation that we're looking to get. Now, over a long period of time, like we put out a long-term capital market assumptions and we upgraded our view on gold. Why? Because there's now two-way risk on inflation. It's not that story of the last cycle where there was only downside risk on inflation. So from a long-term capital market assumption, sure, you could structurally put some gold. But right now, we think that the income that we're getting from the high yield story kind of supersedes and is better than what we would get on the gold story, even though it's had a nice run and it's doing really well right now. We're talking about inflation behaving. Okay, we're not talking about inflation accelerating, and in that environment, we'd rather have credit than gold.
It sounds like you agree with Mohamed El-Erian, who was just on, who was basically talking about how the inflation was probably going to run hotter for a longer period of time, that the Fed would allow this, that the Fed would cut rates this year, but not as much as people would think, and it wouldn't necessarily be all that restrictive because this economy is much hotter. Is that basically the narrative?
And Lisa, I don't think a quarter of a percent of a rate cut is going to do anything for this economy. I think you have an economy, a U.S. economy that's so interest rate insensitive, which is the whole reason why this 550 basis points of hikes did not break the back of the economy and put us into recession. But I think what they're saying is they're way into restrictive territory. They believe that, even though if you really got them to, to tell the truth, the neutral rate is much higher. So I don't think they're much into restrictive territory, but I think they just want to get this thing started. Our base case is June or July, 1 cut, and then we'll see from there.
Why is that not bullish for small cap companies that have been left behind?
Yeah, so Lisa, I think you will get a pop in small cap once we see the whites of the eyes of the rate cut. I just don't know how you can, create a long-standing view of small cap over large cap in a world where the Fed is moving slowly. I think small cap does well in 2 different reasons. One, Goldilocks, which we don't believe in. That's multiple rate cuts because inflation is falling like a stone, or the start of a new cycle. The only problem about the start of a new cycle is you need a recession to get there, so you wouldn't want small caps anyway. So, we're not underweight small cap, but we would rather play the quality earnings story in large cap right now.
What is the risk to all of this, your soft landing thesis?
Shelter costs.
I knew you were going to say that.
Fed is making a huge bet right now, huge bet, on supply side immigration, and CBO predicts 1% inflation. That doesn't sound like a lot until you realize that that's the highest since 1910, like 1% immigration. The other one, Amory, is shelter costs. So the line where the chair said that they expect market measures of rents, things like Zillow, to look more like what is actually happening for shelter to come down. So they're making a huge bet on that, Amory. And we believe that if you look at the tail risks, the risk of accelerating inflation, Anne-Marie, is higher than the risk of recession, which is, again, why we don't have that core bond view, and we'd rather be in quality earnings companies and the high yield.
It is a strange one, isn't it, that we're willing to embrace the supply side story in the labour market. So we're talking about tons of people coming into this country, loads of them getting jobs, and then we're not talking about them living somewhere and renting houses. Isn't that a part of the story?
Yeah, that is a part of the story, and I say this all the time. The 3.8% average mortgage rate that folks are paying in this country is good and bad. Good is 3.8 is we're not worried about somebody having debt. The only problem with that is their first-time homes just became their forever homes. So because of that 3.8% mortgage.
You're talking about Lisa?
Nobody's moving. Yeah, I am talking about Lisa.
Lisa's never moving.
So yeah, so John, that is a pickle. The fact that we don't have the housing inventory story.
So this is the Lisa question. Are high rates propping up prices?
I'm sorry, what's that?
Are high rates supporting shelter prices?
Yes. Yeah.
Isn't that weird?
Yeah. Yeah, because nobody wants to move. And the inventories are staying low and the rents are staying high. Now, I think this gradually continues to come down. People are going to have to buy homes over the next couple of years, but very, very slowly. But we're taking the glass half full on that, the fact that the U.S. consumer remains very, very interest rate insensitive.
Do you then believe what one of our guests said yesterday, which is the fact that if interest rates come down, it actually could solve the Fed's issue with shelter, because that is 2/3 of the inflation?
Yes, as long as it doesn't, it's like whack-a-mole with inflation, right? There's a lot of components of inflation. As long as it doesn't spur things like wage growth and service sector and airlines and things like that. But Amory, I'm with you. That shelter number is the number one thing that we're looking at through the end of the year, and what they're looking at, and they're making a big bet that the market measure and the shelter costs are going to converge.
Amazing stories. Phil, love it. Good to see you. Phil Camporelli there of JP Morgan. Equity session highs up 0.25% on the S&P. Let's get you the Bloomberg brief. We can do that with Danny Berger. Hey, Danny.
Hey, John. Blackstone is said to be nearing a take-private deal for the cosmetics company L'Occitane. Bloomberg has learned that the PE firm may team up with the cosmetic giant's billionaire owner, Ronald Geiger, for the buyout. Trading in L'Occitane shares in Hong Kong were suspended pending an announcement today. The company has a market value of about $5.6 billion, with its chairman, Geiger, owning more than 70%. Tesla has reached a settlement over the case involving its autopilot self-driving feature. It involved a 2018 crash in which an Apple engineer was killed on his commute to work while using the feature. The investigation had found the driver had likely been distracted with a game on his phone, while also pointing to limitations with the autopilot system. The settlement comes one day before the case was to go to trial. The terms were not publicly disclosed. Meanwhile, GM's Cruise autonomous driving division is set to resume its testing of the robo-taxi service in Phoenix. Sources tell Bloomberg safety drivers could be back behind the wheel as early as today. GM had grounded the fleet last year after one of its cars struck and dragged a pedestrian in San Francisco. A Cruise spokesperson says the company, quote, had not yet set a timeline for deployment. That's your Bloomberg brief. John.
Danny, thank you. Up next on the program, Boeing's ongoing issues.
Without an absolute reputation for safety and consistency, you simply can't compete. And that's why everybody's worried about Boeing. We've got to get Boeing back to the point where it produces an impeccable product.
That story up next, live from New York this morning. Good morning.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
DOJ or other authorities.
Good faith comes next.
It was going to keep rate World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Stocks positive by a third of 1% on the S&P 500, looking for a bounce after a quiet start to the week just yesterday. Yields are lower by 4 basis points, taking out some of the move higher we saw in yesterday's session. 437.97 in the commodity market. Pretty steady here on crude, $86 and about 50 cents. Under surveillance this morning, Boeing's ongoing issues.
You're looking at Airbus and Boeing as to purchasing airplanes. What you try to do is you try to find the best quality, the best price, the best operating costs. Without an absolute reputation for safety and consistency, you simply can't compete. And that's why everybody's worried about Boeing. We've got to get Boeing back to the point where it produces an impeccable product.
Boeing expected to announce first quarter deliveries this morning. The plane maker may not have delivered any of its 777 jets in the first 3 months of the year. The delays adding to the company's cash flow concerns. Boeing also facing another FAA investigation after a 737 engine cover came apart during takeoff in Denver on Sunday. George Ferguson of Bloomberg Intelligence is with us now on the story. George, the problems, they keep piling up. What are we expecting on deliveries?
Yeah, so we really know it's not going to be a very good delivery quarter, you know, with the FAA review of their manufacturing, Boeing's review of their manufacturing process. We know it's pretty weak. We're thinking it's probably about 70 737s. I think a bunch of them will come out of inventory. Like you said, it may be up to no 777s, maybe 15 or so 787s. It's pretty weak. I don't think the market will care that much. They're going to look more towards earnings and try to see how bad cash burn really was during the quarter.
George, can you tell me what's happening in the factories right now? Can you just describe, is it people sitting around not being able to do anything? What does it look like at the moment?
Yeah, I don't think it's at all people not sitting around, not having anything to do. I think one of the ways Boeing will push deliveries this quarter will be they have a lot of inventory, right? They have inventory of 737s that are built, need some modifications before they go to a customer. They have 787s that are in the same position. So I think what you'd find at Boeing if you're out there today is there's some people reviewing the manufacturing process. There's probably a slow level of manufacturing going on in the factory, but there's probably a lot more emphasis on getting those inventoried airplanes, again, built but not yet delivered, needing slight modifications. They call it the second factory, getting them out to customers, trying to get them off the balance sheet. They become a pain from a maintenance standpoint because they're built. They've got batteries that have to be maintained, engines have to be maintained to a limited degree, and so they become a real drag.
George, I think a lot of people are grappling with exactly when this story is going to turn a corner. How much we're seeing sort of a deadline for when we'll have investigations finished, some sort of sense of who the successor is going to be of Dave Calhoun, and when they can start rebuilding at a time where it is a duopoly and a lot of airlines depend on them. Do we have a sense of that?
Yeah, I mean, it's difficult, right? Because the aerospace industry is just not a fast industry. You know, everything just takes a little bit longer. I suspect you're going to be well into second quarter before you're hearing a lot about, you know, the manufacturing review and what Boeing's putting in place to ensure quality. And I suspect you'll be well into third quarter before you even hear the CEO change. So I think you've got sort of 2 quarters here of real variability. I think a lot of people are hoping by year end we know who the CEO is. We know what the game plan is. I do suspect build rates will get better, though, in 2Q and in 3Q, but not be a target sort of 38 737s until the end of the year.
Are we going to hear any good news at all coming out of Boeing?
I mean, in 1Q, I suspect not, right? The other challenge here, right, is you've got a management team that's waiting for the next one to come in, right? They're waiting for the board to go out and find the new CEO. And so I don't know that they have an incentive to try to, you know, show either a good face or, you know, I don't think they're going to try to show a bad face, but I think they'll give you the straightforward numbers, and they don't have all the answers about where Boeing's going because they're not the management team that's going to take them there. So I think you're going to find a pretty, you know, bland, as a matter of fact, first quarter report.
George, how much is Airbus taking advantage of this and ramping up production and trying to basically consolidate how much of an advantage they have?
They would love to take advantage of this, but the challenge really is the supply chain in the industry is strapped as well. And Airbus has the same problems in their supply chain, not to the same degree, but they have some of the same problems in their supply chain that Boeing has. And that is that supply chain can't find workers as well. That supply chain is bouncing back after the pandemic. They have to be very careful about their quality too. So the challenge for Airbus, I think, is they can't really make as much, hay, if you will, out of this whole event. I think one of the interesting things we're seeing out there, though, as we see Spirit Airlines talk about not taking some of their airplanes from Airbus, JetBlue as well. I think what we're seeing is Airbus working their customer base to figure out who wants airplanes now, who might be willing to take them later, trying to get some conquest. I think they're working on that United order. I think they'd love to get United in their order books for 321s, A321s.
I bet. George, thank you, sir. George Ferguson there of Bloomberg Intelligence on the latest with Boeing. You from Denver?
I did.
To the engine cover? What was that?
Unbelievable. I mean, just falling off as they were going up. I mean, these are, again, not headlines that you want to hear. I do wonder, do we just hear more about this now because we're more attuned?
Yeah, I was asking that question myself too. Don't know.
Because, I mean, there have to be mishaps that happen occasionally.
And so many passengers have mobile phones and they're all taking photos and videos and posting it on X. But now this is just means another bad headline for Boeing because the FAA is stepping in and investigating this
Used to be a
incident.
window seat guy. I think I'm going to become an aisle seat guy.
No, really?
Yes.
So do you
Yes.
prefer the window seat because you can go to sleep?
Control
or the
ground.
aisle seat? It's the control of that or the control of being able to get up without asking other people to get up first?
Control
Lots
and
of control.
that, which is control again.
Exactly.
Right? It's
So
control.
which control would you prefer?
Both. But you've got to give them up if you take the aisle.
He wants a
right?
private jet.
Exactly.
You've got to give them both up.
Have you ever bought the whole aisle just so that you didn't have to deal with
No, that's
grappling?
ridiculous. Do you mean like bought two seats?
Yeah.
No, absolutely not. No.
But you've done that.
What, if you buy two seats on
No,
a plane.
I never would. But there's always a debate with the kids about who gets window, who gets aisle.
How do they decide?
They all want the window to sleep, but if they are not tired, they argue over the aisle.
But you have control over that whole row, but it sounds like you're getting stuck in the middle.
Always.
That's awful.
Window for leisure and aisle for work. Get off the plane fast.
Ooh, that's good.
That's what I would typically do, but now I think I'm just an aisle guy.
You just know our bosses are listening.
Just an aisle guy.
I don't
No,
care.
for when I'm coming home, AMH, and get back home quick. Coming up next, Morgan Stanley's Seth Carpenter. Looking ahead to inflation data, that conversation just around the corner. Here's how the market is set up this morning. Equity futures on the S&P positive by 0.2%. In the bond market, we made new highs across the curve yesterday, 2-year out to 30 years. We've backed away since then. We're down about 3 or 4 basis points on the session to 438.37. Lisa tells me to get excited about some auctions. We get a 3-year note a little bit later, $58 billion worth, and then we'll get $39 billion of 10-year notes, $22 billion of 30-year bonds. So the party starts a little bit later this afternoon.
Oh my goodness, I think that you couldn't sound more excited if you tried.
Yeah, no, that was me excited.
That was whoa. Let's talk about rate cuts at this party.
That and the eclipse and,
Oh, the eclipse was fantastic. Stop throwing that into
No,
this.
I was excited about that. Like, great moment for the community and
stop.
And window, if you had a window seat.
brilliant.
you formed a partnership with Penny Pritzker at some point to do parking. Is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. Then I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Here's a response. Come on, you never have to choose between aisle or window in the Bloomberg private jet. The aisle is the window.
Who's that from?
Bombardier from Bloomberg. A couple of comments like this on a Bloomberg terminal. You either fly first class or the private jet with Bloomberg. Aisle window, you know.
They think that we live...
TK's life.
TK's life.
Yes.
I will just
Yes.
give you that.
TK has led everyone to believe that we live a certain life that we do not. Equities right now on the S&P 500 positive here by 0.2%. Equities are up a third of 1% on the NASDAQ. We've got a bounce here. Let me tell you how quiet this morning is. Okay, so on the Bloomberg terminal, there is a function where you can go and have a look at the most read stories on the Bloomberg terminal. And I can tell you the most read story in the last 8 hours is a former Fed president's view on rate cuts this year. That just tells you how quiet things are in this market going into tomorrow.
It does feel like there's absolute stasis. And the one anxiety point is, what about rate policy? And somebody saying that basically you're fine is the most read story on the terminal. I will say, climbing the ranks, though, is the State Street and the half-point rate cut. And that was something that people were really interested about. We heard from Mohamed El-Arian that essentially that would be a policy error should it be effectuated.
Well, that's if something goes wrong, right? Surely that's why you get 50 basis points. What does State Street actually say about that? Because if I think 50 basis point cuts, I think problems. I don't think supply-side solutions. I think like growth falling off a cliff and the Fed responding to it.
That's essentially what their argument is, that the economy isn't as strong as it seems. And they point to delinquencies, and they talk to small businesses and how much they're struggling. This is the tension right now. Is there something we're not seeing? I don't know. It hasn't really come through in the numbers.
Hasn't come through in the bond market either, because yields have been higher. It's certainly not been lower. Let's check out the bond market together. 2-year, 10-year, 30-year. High of the session yesterday at the front end of the curve, 479.28. So we came really, really close to 480. Breaking lower a little bit today by 3 basis points. We're down 3 basis points on a 10-year as well to 438.57. I've been joking about the supply. We can go through the numbers again. I know they're important, Bramley. So let's start with the 3-year issue. It comes a little bit later, $58 billion worth. Then tomorrow we'll get the 10-year note, $39 billion worth. The 30-year bond, a little bit later on in the week, $22 billion worth. Does supply start to reassert itself in a negative fashion in the same way it did, say, back in September, October?
I'm not sure it's the supply itself, because a lot of people have said that's not really at play. What it is it's a domestic buyer base that's much more price sensitive that will be buying. So what's the rate that they see as compensating them for the risk that the Mohamed El-Arian view of the world of higher inflation for a lot longer is actually the correct one? And that's what I'm looking for.
Let's turn to foreign exchange as well, and we can finish on the euro. Take a look at dollar yen as well. The euro at the moment against the US dollar shaping up as follows. We are positive by 0.1% at about 108.69. Dollar yen looks boring, but it has been interesting. Basically unchanged at the moment at 151.79. Lots of suspicion that the closer you get to 152, the more likely it is that the Bank of Japan steps into the market. We got to 151.93 in today's session. This one, the moves in it have been tiny. over the last few days. Really, really small moves in dollar yen, because there is this belief that the closer you get to 152, the BOJ is going to step in. I'm with you. I'm with Steve Englander at Standard Chartered. I think the inflation print tomorrow morning is going to be pretty important for the Bank of Japan as to what they can do. If you get a hot CPI print, yields up, dollar rips, they've got a bigger problem, haven't they?
They have to deal with it from the monetary standpoint. They can't deal with it by coming in and trying to support it with fiscal, some sort of fiscal response. And that's, I think, the reason why people are looking to CPI before they make anything significant in terms of moves.
Under surveillance this morning, our top stories look a little something like this. Treasury Secretary Janet Yellen wrapping up 4 days of talks with her Chinese counterpart, threatening sanctions for any Chinese bank that aids Russia's war machine. Her message coming as Russia's Foreign Minister Sergei Lavrov arrives in Beijing to meet with Chinese officials. And I imagine that was a message for him as much as it was a message for them.
Absolutely. And we've seen the United States talk about this, but this was really more of a direct message from the Treasury Secretary about what this could mean. But we heard from Mohamed El-Erian in the last hour talking about the fact that sanctions, not his words exactly, but don't really work. What they do is they create other markets. And potentially what we could see if there was to be harder sanctions on China in terms of these dual-use cases for certain goods going into Russia, Russia will just find them somewhere else.
U.S. policy and the weaponization of policy. Mohammed's thoughts on this and what was happening with precious metals was really, really interesting. When you went to the record high on gold, Lisa, and we started to ask him what's behind it, and he started talking about U.S. policy and diversifying away from the U.S. dollar-denominated assets. And we said, why? Is that about policy, sanctions policy, or is that about Treasury supply? He said it was about sanctions policy. And this is the de-dollarization theme, a word, a phrase he didn't want to use that people were picking up on over the last year or so.
Or diversifying away from it a bit more. And that's the reason why you saw actually central bank buying of gold tick up so significantly, led by China. This is the reason why you have people also front-running expected additional purchases by foreign central banks of gold to continue diversifying as they go. And that's been one of the big suspicions behind the gold rally that we've seen so far this year.
Big moves, more all-time highs. Gold this morning up by another 0.4%. Let's get to that most read story on the Bloomberg terminal. The market's pricing in 2 Fed rate cuts this year, but former Fed President Jim Bullard expecting more. Bullard telling Bloomberg TV the following: you should probably take the committee and chair at face value. Their best guess right now is still 3 rate cuts this year. That's the base case. What have you learned from that, Lisa?
Basically, that he doesn't want to make waves, and that basically he's consensus. I don't really know what else I could say about that.
Nothing else to say.
That's essentially it.
And if that's the most read story in the Bloomberg terminal right now, I'm not sure what to say either.
That it's not a very active morning.
It's a very quiet morning.
And basically we're looking, I mean, it's a quiet morning, and nobody wants to make big, bold bets before CPI or Delta earnings.
The week begins tomorrow morning with Delta earnings. We've been told repeatedly, honestly. Investors in wait-and-see mode as the week of data kicks off tomorrow morning. CPI and Fed minutes coming on Wednesday, PPI on Thursday, and big bank earnings to round out the week on Friday. Morgan Stanley's Seth Carpenter joins us now to talk about a few of these themes. And Seth, it's good to see you, sir. I want to begin with immigration into the United States because the numbers are absolutely stunning. Could you frame how big those numbers are and the kind of forces they're having on the U.S. economy?
Yeah, thanks, Jonathan. I think even before we get there, I will say I'm a window seat guy. So if you're still thinking about switching teams, stay with me in the window seat. That's sort of where I like.
I'll fight you for it, Seth.
For sleep?
For sleep, primarily, exactly. No, but on immigration, the numbers are really big. And here, big shout out to our U.S. economics team led by Ellen Zentner. We spent a lot of time with folks in Washington at the government agencies looking at these numbers, coming up with our own take on the new information that's available. And I think the takeaway really is huge increase in the number of workers in the economy. If you thought that the break-even level of job creation each month had been about 100,000 per month, it's at least twice that. And I really do mean that's a big change. And so as a result, you hear comments like Chair Powell saying it's a bigger economy, it's a bigger labor market, not a tighter labor market. We're very much in line with that view.
So it's non-inflationary in the labor market. Is it inflationary more broadly in the economy, Seth? The additional demand, the additional competition for housing, how does that play out beyond just the labor market?
I think there's no doubt that there's both an demand component to this and a supply component to it. But what we have to remember is on the inflationary side of things, this is all playing out against a backdrop where consumer goods inflation in level terms had been boosted so much because of supply chains and the shifts we saw during COVID, and those levels are coming back into place. And then we saw rent inflation that had jumped up because people's housing demand had changed with COVID. So the normalization that we're seeing there, I think, is actually more important than the additional aggregate demand that we're getting from the extra labor supply. And so we're still looking for disinflation to continue tomorrow morning's print and through the rest of this year.
Seth, I'm struck by how much fiscal policy, just more broadly, and frankly, federal policy, has driven so much of the story and will continue to in a way that makes it very difficult to predict. I think about not just the immigration story, but also the fiscal deficits that have been incurred as the government has given all of these fiscal stimulus payments across the nation. You had a projection looking out about how much the deficits would increase under either the Democrats or the Republicans, and that the Republican deficit would actually be twice as big of in terms of the increase versus Democrats. How concerned are you about this? How much is this playing into the overall story?
I think it's impossible to ignore. It's clearly going to be a critical question that everyone's going to see what happens in November, who wins the White House, who wins the Senate, who wins the House of Representatives, and what policies are being pushed. The House view now at Morgan Stanley from our public policy team is Democrats' biggest priority over time has been infrastructure and green energy. The IRA is in place, and so a big extra boost for spend probably isn't there. And for the Republicans, the Tax Cut and Jobs Act, biggest priority, that was already put in place, so probably not another huge change there. And so we are thinking the Democrats, you get a bit more in terms of spending, you get a bit more, though, in terms of tax increases under Democrats, whereas for Republicans, if it's a sweep, you get some tax cuts and you get some extra spending, hence the difference in our House view in terms of what happens under the two scenarios. But we cannot rule out the very likely possibility that we get the White House controlled by one party and Congress either split or controlled by the other party, which just adds another layer of complexity.
But even if the White House is controlled, say, by a Republican and there's a split within Congress, potentially we're going to get higher tariffs. Trump 2.0 can do that pretty much unilaterally, and restrictive immigration. What does that mean for inflation?
Great question, and I think it is exactly the sort of scenario every investor has to be thinking about right now. I think tariffs, no question, on the table. Former President Trump has referred to it explicitly, and there I think we have to balance what we know has happened in the past, which is to say a bit extra cost for importers, some of which gets translated to final prices. However, we also know that last time it was a massive hit to the U.S. manufacturing sector, and so as a result, you'll get an adverse hit to growth, and so that goes in the opposite direction for inflation. When it comes to immigration, that's the tricky part. If we look at some of the projections, we look at the CBO's projection, already some reversion back to pre-COVID rates of immigration. And so I think the real question is, what's the marginal effect of any more restrictive policy? I think directionally it has to be less of the beneficial supply boost, but also a little bit less of that aggregate demand. But it's coming at a time, say in 2020, late 2025, early 2026, after a new administration's in place and policies have time to take effect, where we already have most of the inflation wrung out of the system by the Federal Reserve under our forecast and under the Federal Reserve's forecast.
So, Seth, that's sort of the longer-term view that any of these policies wouldn't necessarily filter into true economic data for a while. But do you see some of these proposals as spurring a market reaction that could materially shift the economic projection? For example, if you did get the scenario that Anne-Marie was talking about, with higher tariffs, lower immigration, could yields spike to a level that could be really problematic for the economy?
Unquestionably, and I will say one of the most common sets of questions that we have from clients are exactly along these lines. Would that scenario, the Republican scenario, be very inflationary? Would it cause a further sell-off in rates? Lots of people are angling now and trying to see if they need to position for that. I will hasten to add, though, if we go back to last June, July, August, September, October, when we did see a big sell-off in rates, there were lots of narratives people were looking for, and then we saw a reversal. And so I think this is going to be one of those tricky periods in time where very legitimate concern over one scenario that is very, very plausible, people could easily run with for a while. But then we really do have to wait and see how the election turns out to see if those policies go into place.
How do you then plan for what the Fed is going to do in 2025?
I think the Fed right now is at a place where they are taking it one meeting at a time and one data print at a time. You referenced at the beginning Jim Bullard's comments about taking the Fed's baseline path at face value. We actually have in our base case 4 rate cuts from the Fed this year, because we're looking for inflation to keep coming down. So we're a little bit below consensus for tomorrow's number. We see disinflation continuing all year and picking up speed in Q3 and Q4. And as a result, we think they'll be able to cut rates a bit more. So by the time we get to 2025, there'll be so much more information about where inflation is, so much more information about how sustainable this increase in immigration has been, that I think the Fed themselves don't really put much stock whatsoever in their own forecast for policy for next year.
Seth, are you still sticking with that mid-90s story?
The 90s were great, right? So that was when I became a real economist, graduated from college in 92, got my PhD in 97. So that's where I became an economist. Look, I don't think any 2 cycles are exactly alike, and you can't take one cycle and use it as the template for the next. However, lots went on in the 90s. We were still seeing the rise in labor force participation. So there's a bit of that supply side to the story. There was an overall aggregate supply side to the story. The Fed pulled off a soft landing, which most people at the time and even now think can't be done. So I think there are a lot of lessons to be learned from the 90s, but we would be misguided to try to take it literally at face value.
A precedent for the unprecedented. Enjoyed the note over the weekend, Seth. Thank you, sir. Seth Carpenter there of Morgan Stanley on the latest. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg brief. Pfizer's plans to apply for wider approval of its RSV vaccine have been spurred by new test results. A single dose of the vaccine produced a strong immune response in adults aged 18 to 59 with conditions such as asthma, diabetes, or chronic lung disease. RSV is a flu-like illness that affects elderly adults and babies most severely. Bloomberg Intelligence says the market for adult vaccines alone could reach $11 billion by 2032. Elsewhere, Senate Minority Leader Mitch McConnell voicing his support for a bill that would require TikTok's parent company to sell the app or face a ban. The senator says requiring ByteDance to divest from TikTok lands squarely within established constitutional precedent, and it deserves urgent attention from Congress. And finally, the records keep coming for women's college basketball. Sunday's championship game between South Carolina and Iowa drew a new record. A TV audience of 18.7 million viewers. ESPN saying that number peaked at over 24 million viewers in the second half. Those numbers expected to rise when the final Nielsen numbers are released later today. It ended up being the most viewed basketball game, pro or college, since the men's championship 5 years ago. Fantastic figures coming out of that.
It's the only one I ever tuned into. I'm part of those figures.
You know, we're not talking about the men's championship, not talking about that at all. Jim Bianco Research just wrote in.
I got the same message.
I absolutely love this. Bullard is now the chairman of the economics department at Purdue. He spoke to Bloomberg TV from Hong Kong literally in the middle of the game. Why wasn't he watching the game?
Evidently, he also wasn't as interested because he's more interested in saying that the Fed, take them at their word. There are going to be 3 rate cuts this year because that's what they say.
It's because they don't have Caitlin Clark. There's no Caitlin Clark in the men's world.
I love that. So he went to the HSBC conference and talked about the Fed instead. Up next, rethinking the Fed's 2% target.
Inflation will be sticky. Inflation will be absolutely sticky. We're going to get stuck at around 2.5% to 3%. And I do think that that actually warrants, over the long term, the Fed rethinking its inflation target.
That's up next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal?
The deal. The deal.
That deal.
The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
"41 minutes away from the opening bell. Equity futures doing okay, up 0.25% on the S&P 500. Yields a little bit lower, down 4 basis points. The yield on a 10-year, 4.3777. Under surveillance this morning, rethinking the Fed's 2% target.
I think Chair Powell has made it very clear that he's willing to look through these bumps. They will need overwhelming evidence that it is more than a bump in order for them to change their views. Inflation will be sticky. Inflation will be absolutely sticky. We're going to get stuck at around 2.5% to 3%. And I do think that that actually warrants, over the long term, the Fed rethinking its inflation target.
Controversial thoughts there from Mohammed Al-Arian. All eyes on tomorrow's CPI report. Investors waiting to see if we'll get another hot inflation print. Joining us now is Afsana Beschloss, the founder and CEO of Rock Creek. Afsana, great to catch up with you. It's always good to see you. Mohammed was talking about maybe more hot inflation prints in our future. Every time we get one, the Federal Reserve calls it a bump in the road. How many more bumps until they're no longer just bumps?
Yeah, that was in fact the title of our letter last week. And we should expect more bumps along the road, and I think we're seeing the different factors that are contributing to inflation changing, though. During COVID, we had everything going into the inflation numbers, whether it was oil, whether it was commodities, everything was going up at the same time. What we're seeing today is very different in the sense that, for example, oil prices are going up. And we could argue that they could just as easily, if the Middle East tensions came down, there would be the oil prices coming down with them. But that's why we do think that the road will be bumpy, because those kinds of geopolitical events are things that you cannot plan for. And at the same time, a lot of the supply chain issues that did contribute broadly to the markets have disappeared. So I would not assume that inflation numbers would be super sticky, but they would certainly be bumpy.
Afsana, one thing that we've been talking a lot about this morning in the past couple of weeks has been, it's not just oil prices, it's also copper, it's also iron ore, it's also a whole host of other commodities that are really being driven, what a lot of people say, is by demand, which isn't necessarily something that is as transitory. How are you playing that or understanding that in your investment thesis?
So there is factors like copper. We're seeing, for example, Chinese demand growth because they're starting to produce more EV cars. And we had Janet Yellen there talking to them, and the Europeans concerned that they're dumping the markets with EV cars. Now, that's a positive force, getting more electric cars into the markets. And that will continue, that force will continue and push certain kinds of commodity prices with them. And we will continue to see that. But I think we are seeing some short-term impacts, for example, specifically on copper that we've seen. The other impacts that we're seeing on things like gold, which are completely different. And I think the biggest force there is central banks trying to diversify their sources of reserves. post what happened to Russia a couple of years ago when their reserves got frozen. So you're seeing gold become a store of value for the central banks that are trying to have, particularly in China, Russia, and some other emerging markets, as a source of their reserves.
We heard that for a second time now this morning. Mohammed El-Arian had a similar point. But to the commodities, copper, Citi says, is entering a new bull market phase. But the whole story in China is that the property market is still deteriorating. When you look at EVs, those are things like cobalt and lithium. Why do we see the entire commodity spectrum going higher, even though the stories are different coming out of China?
I think what we're seeing is in the factors that in China you have, interestingly, not been able to necessarily generate profits from the production and the manufacturing of certain goods, but at the same time there are certain political forces and market forces and forces in their companies to produce more goods for the green economy. And by the way, it's not just in China. You're seeing that in India. You're seeing that in parts of Latin America. Of course, in the US, huge forces going in that direction. So it's not just a Chinese factor. And I think we will continue to see these forces. But let's not forget, there are also, at the same time as the demand is going up for these goods, there is supplies that are being found in places like in Norway. Now, it's a long delay to get some of these supplies into the markets, but no question that the supplies will also start dampening things in the longer run. In the shorter run, we will see these bumpy ups and downs.
Afsana, how much more does the gold trade have to run, given the fact that this diversification story potentially has legs?
I think this diversification story will continue. I think we have gone through this. If we look over the last, 50, 100 years in terms of the place of gold in central bank reserves, it has gone up and down through time. And at times where people were less certain about certain political factors, you have seen the place of gold become, gold taking a much bigger share. I think right now what we're seeing is more of a medium-term impact. There's more central banks that will be continuing to add to their reserves, but it's not like a major, and some retail will follow that probably, but it's not like a major change in the value of gold. Let's not forget, gold does not generate returns beyond its asset value, but it doesn't have a rate, attached to it. So I don't think it will be a very long-term impact.
Afsana, just quickly, I've only got 20 seconds. Now you're on the board of Carlisle. Do you have to support Baltimore baseball? Is that what David insists on?
I'm not yet on the board. I'm joining the board.
And just quickly, I've only got 20 seconds. Now you're on the board of Carlisle. Do you have to support Baltimore baseball? Is that what David insists on?
I'm not yet on the board. I'm joining the board, and I will have to look more for all the baseball teams that my sons are supporting. So Orioles is definitely one of them.
Very wise. Afsana, good luck with everything. It's great to catch up with you. Thank you for your time. Afsana Bestos there of Rock Creek Group on the latest. Coming up tomorrow, things get interesting. CPI comes in. Dow to earnings, I'm told.
Thank you.
As well. Okay. Francis Donald's going to join us of Manulife. Lisa Shallard of Morgan Stanley. Steve Rasciuto of Mizuho. David Kelly of JP Morgan. A lot to talk about tomorrow morning.
Especially given the fact that we have the confluence of Delta, CPI, and then a Treasury auction of 10-year notes.
Yeah, it does look like Delta sales, though, according to Bloomberg's second measure, they fell, Lisa, so
I've got to get on that.
The opening bell, 34 minutes away, live from New York City this morning. Good morning. This was Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
I think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera. And I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
From New York City, for viewers worldwide, a very good morning. I'm Manus Granny in for Jonathan Farrow. Stocks are managing to eke out a bid this morning, but small business optimism is at an 11-year low, and this the Fed should pay attention to. So says Mohammed Al-Arian. We'll count you down to the open. It kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Show markets on edge ahead of another big inflation report. Former Fed President Jim Bullard makes the case for 3 rate cuts. And oil prices around a 5-month high as geopolitical tensions simmer. We begin with the big issue. It is the great rate debate, and it's heating up.
I look at the beginning of the year, which isn't that far, that many months ago, we were looking at 3, 4, even 5 cuts. So I think that the market is still uncertain. What does that say to me, though? It says that we have flexibility, and that's such a great thing. Look at Jamie Dimon's letter, which came out. He's looking at what? The market's saying 70%, 80% chance of a soft landing. Well, what if we're wrong? We have tools here. We have the ability to cut rates and stimulate the economy if we see those signs of weakness.
We have the ability. The powder is dry. Let's discuss. Investors Matt Brill and Patrick Frizzetti join me from Rose Advisors. Good to have you both with us. So here we are. We just had that conversation this morning about the flexibility. There is debate within the Fed. There's flexibility to respond if things slow down and unemployment rises. But my question to you both is, as Bullard reinforces the case, he doesn't vote anymore, he's not part of the Fed, but 3 cuts is what he would be doing. Are 3 cuts an insurance premium that we need in this market, Patrick, to ensure the Goldilocks soft landing? Good morning.
Good morning. I don't know if it requires 3 cuts. I think we're a data-driven market. We'll have, obviously, our CPI figures come out on Wednesday. I do think that the labor participation rate ticking up by a little bit last week does leave, a June cut still on the table. But, I don't know. I think, it's going to be a data-driven market, and obviously the result will be, if there aren't as many rate cuts, I think we'll see a lot more volatility in the stock market.
Are we ready for that volatility? I mean, we haven't seen a drawdown of more than 2%. Matt, good morning to you. We haven't seen a drawdown of more than 2% in this market. We haven't seen virulent reaction to this bond market. It's trading up at 4.5%. Should we prepare for and spend money on volatility, whether that's bond vol, equity vol, or cross-asset vol?
Well, I think at this point, the economy continues to be just incredibly resilient. You could say it's as strong as UConn and USC's basketball teams, and so it just keeps going and keeps going. But at some point, yes, we will have some volatility here. We're going to have some hiccups, whether it's on the growth side or on the inflationary side, it's yet to be determined. But vol has been low, but one of our main themes for this year has been that we will go back to normal, that we don't have to have these extreme levels of volatility that you've had from basically the start of the pandemic. So, yes, volatility may pick up a little bit, but to the extremes, we don't think so. So we'd be big sellers of vol if it were to increase from here going forward.
Okay, there you go. Let's see who would be the buyers and the riders of vol in this environment. Look, we're bracing for CPI, so let's get ready for that. Mike McKee joins me to set the table. We're looking for a dip on the core, but the year-on-year, Mike, can't be ignored.
Yeah, it's kind of an interesting situation because we get into base effects, so we're going to see a difference between the year-on-year and month-on-month in the way they go forward. At least that's the theory behind the consensus estimate of economists that we surveyed. The headline numbers are both, and the core numbers, both supposed to go down on a month-over-month basis by a tick. Headline year-over-year, though, would rise. That's largely because energy prices have gone up. The core on a year-over-year basis goes down. Now, of course, progress is what the Fed is looking for. Will we see continued progress? You got to take it apart. I want to show you two things here. One, all the way over on the right-hand side, goods deflation was behind the fall in CPI, but look what happened last month. It went up a little bit. Now, is it going to continue going up? Have we seen the end of goods disinflation? And as you can see there, last month we had a little bit of a rise in services inflation. What happens with that? That's something to watch. Also, check out the y-axis there on the right-hand side. I was talking with Mohammed El-Arian this morning about this. We are now down to parsing three-digit changes in the CPI. That's how close we are to the, I guess, target, or close we are to how various economists are thinking about it. And one more thing that we have to look at tomorrow is going to be housing, because that's been the biggest problem for the Fed. And you can see here in our ECAN function that the owner's equivalent rent has come down, but it is still a major contributor to CPI overall. Rent of residence, still a major contributor to CPI overall. So at this point, that's what everybody's waiting for. Do we get a bigger drop as we go forward, and does that finally start to pull down that core CPI?
Okay, well, all eyes down for that, and why be a hero taking risk in the next 24 hours? My guests this morning are Matt Brill and Patrick Frizzetti on these markets. Matt, you still maintain it's going to be the year of the bond. It hasn't been thus far. We've lost 2% so far, but you're expecting positive returns. I mean, we are nickel and diming now over these disinflation narratives. So what is it that reasserts the year of the bull? Matt?
Well, structure down 67%.
First off, just where we are in corporate credit spreads, as well as just all in yields being at 5.5% roughly, gives you a good start. As I stated, the economy continues to plow through this. At some point here, we will see some hiccups. I'm expecting a reasonably decent CPI print tomorrow. Is it going to be a straight line lower in terms of inflation? No, absolutely not. It will be bumpy. But as you get that, I do think you will get
Gentlemen, just 1 second. 1 second. Just 1 second. We've got a small soundtrack issue ongoing at the moment, so we're just going to try and sort that out. let's just go back to the team. Patrick, in terms of where we are. Sorry about that. There was just a moment of confusion on the soundtracks there. Listening to Mike, listening to the agenda in terms of CPI, do you think, Mohamed, I mean, we had the small business survey this morning. Mohamed El-Erian makes the point, the Fed should be listening to that a lot more acutely than they are to nickel and diming over the CPI.
Yeah, I think that's fair. But, you know, I just look at some other indicators. I mean, just look at what has happened with commodities. And it's across a lot of different commodities, precious metals, obviously in the energy market. And I think that that is signaling something. That is signaling that if the Fed does cut based on where inflation is today, that they are basically saying that they're accepting more inflation. And so I think that is an indication of what's going on. Granted, the economy's healthy. There's a lot of, you know, buying in Asia of precious metals and copper. But I think that that's an indicator. And so, you know, again, if they do follow through with some rate cuts, it may be short-term stimulative, but overall, you know, we're just focusing on having a balanced portfolio, both fixed income and equities, and not following the momentum trade in the equity side of the equation.
Do you think we run the risk, again, a lot of stories have been written recently about momentum fading. The risk is that momentum fades. It's been a huge driver in this first 3 months of the year. Do you think that that is a key risk at the moment as we turn over into the earnings season?
I definitely do, because, you know, I don't think it's going to take a lot to roll over on some of these momentum trades. And so, you know, again, if you have the opportunity to rebalance your portfolio at this point, you should do it. And I think, you know, you're still kind of getting paid to wait, you know, with where, you know, money market rates are and bond yields are. So I think it's fair to make some adjustments at this point in the year going into earnings season. You know, the momentum trade, I think, has just gone way too hot at this point.
It's interesting because, of course, those money market funds, people who were maybe going to pull the trigger towards the back end of the first quarter, it's now extend and pretend for those. I was drawn to what Wells Fargo had to talk about this morning with me a little bit earlier. They're talking about secular optimism, and this is what they had to say. In our view, the bull market, AI, secular growth story, and index concentration have shifted investors' attention away from traditional valuation measures and towards longer-term growth and discounting measures. And I suppose the question here is the valuation threshold seems to have decreased, and you know, the time horizons have increased, and that's the point that they make. Do you think we're slightly over our skis in terms of the models that we're using?
Well, yes, because, you know, when you're looking at discount rates, I mean, discount rates today should be higher. But they're still using, you know, they're basing it on expectation that the discount rate will go down. And in many cases, I think they're expecting the discount rate to go down significantly. And if that were to be the case, then maybe, you know, some of these current models will work. But that is, you know, we're sort of old school when it comes to valuation metrics. I mean, it's math. So, you know, we tend to side, you know, on you know, the mathematical, factual based part of valuation. So, you know, look, none of that has changed. And look, there's still pockets of the market that are very interesting. Certainly, if you're focused more on the value side of the equation, away from momentum, I think there's some very, very interesting companies out there that you can invest in today. And like I said, in the fixed income space, you can balance out your portfolio with some fairly attractive yields still.
Patrick? Just hold those thoughts. We've now managed to reestablish communication with Matt. Matt, you were robbed. You were robbed. Let's go back to where I started, which was you are a believer in the year of the bottom. My question to you was very simple. We've had so many false starts in this call, not just your call, but many people's call. What is it that makes you believe we're still going to have the year of the bond? We're down 2% at the moment. Real money, in theory, is supposed to come in. So what is it that really ignites the year of the bond?
Yeah, good to be back on here. So, yeah, I think what's eventually going to happen, and this is what we saw last year, right? We lagged all year long. We lagged cash, and then we came through in the fourth quarter and ended up 7-8% for the bond market. I think it's entirely similar or possible to see a similar thing that happens this year. And when you have a coupon of 5.5%, which is where the investment grade market is currently trading, you know, as Patrick was saying, there's math behind all this. Math starts to help you at a certain point. And the bond math tells you that if you go 100 basis points tighter, you're up double digits. If you go 100 basis points, you know, wider or higher, you're basically flat. We think that you will be lower in all-in yields, and by the end of the year, you will be in high single digits. So at some point, the bumpy road of inflation will start to prove to be a little bit more linear. At some point, the economy will start to slow just enough to see a few cracks out there. And we have a Fed that is wanting to cut. Yeah. They just want any sign that there's any sort of slowdown in the market, and they will cut. And when that happens, you'll start to get really positive total returns.
As soon as that window opens just half an inch, they'll be in like Flint. Matt, thank you very much. Matt Brill, good to have you back. Sorry for the interruptions on sound to you and to our viewers. Patrick Rossetti, my guest this morning on the markets. Let's look under the hood ahead of the opening bell. Abby's with me. Abby.
Well, we do have some stocks moving in a big way. One of them is Tilray. The marijuana stock is plunging down about 15% in the pre-market. This after they cut the full year guidance and the third quarter net revenue miss. So a big decline there for that stock. Delta Airlines up about 0.4%. They report earnings tomorrow. Analysts are relatively positive. In fact, we even have Susquehanna raising their price target to $54 per share, suggesting some nice upside potential could be ahead. And then AT&T heading to a fourth down day in a row in the pre-market, down about 1.5%. If that loss holds, this stock, Manus, will have lost more than 3.5% over the last 4 days. They will be reporting earnings in about 2 weeks.
Okay, pretty brutal run for them. Abby, thank you very much. Coming up on the show, Israel optimistic on ceasefire talks.
The question for Israel is what they are going to do, how and when they are going to go into Rafah. Right now, as I had mentioned, the ceasefire talks are really very close, and there is a huge amount of international pressure, including from the White House.
That conversation to come right ahead on Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
20 out of the 24 battalions of Hamas's military have been dismantled, and the 4 that remain are in Rafah. So the question for Israel is what they are going to do, how and when they are going to go into Rafah. Right now, as I had mentioned, the ceasefire talks are really very close, and there is a huge amount of international pressure, including from the White House.
Let's judge that optimism about a ceasefire and talks coming from Israeli officials. The foreign minister says this: we've reached a critical point. If matters work out, a large number of hostages will return home, and then in stages, everyone. And I'm optimistic. I'm more optimistic than I was. This coming as Hamas has said there's been no progress on the talks. Amri Hordern is with me now. Amri, how much of this is internal Israeli moment of shifting, and how much of it is pressure brought to bear by Lord Cameron and by the American administration?
Well, there's a ton of pressure, international pressure, that is weighing on the Israeli government. And then it's a great point. There's some domestic issues as well, some of those even more put to the right of Netanyahu that he is dealing with at the moment. What we saw is the defense minister talk about that these individuals, members of the IDF that were being withdrawn from Khan Yunis, the defense minister saying so they can prepare for an eventual invasion of Rafah. Over the weekend, though, we heard from one Democratic senator, Senator Chris Coons of Delaware, is very close to the administration, talking about the fact that potentially this is a tactical movement because they have to redirect potentially some troops if there's going to be some skirmishes with Hezbollah on their northern border. And then, of course, you have an administration who likes things to take the view that the reason why you did see some of this withdrawal is actually because of the pressure the U.S. is putting on Israel. But the headline for me yesterday was Netanyahu said he has a date for when he plans to go into Rafah.
And in terms of the next steps for these negotiations, Amory, when you have Hamas coming down so hard on a negative side, what is it that we understand in Egypt will shift the dial?
It's a great question, because Hamas said yesterday that they do not see progress in the talks and that there was no deal on the table. Yet we do see that pressure really from the United States. They had sent Bill Burns over the weekend to these talks. They would like to see a hostage deal and negotiation. There's still a lot of pressure from these families as well on Benjamin Netanyahu. The Israelis say progress has been made, but when Hamas says no, it feels like we're here once again, Manus, at a standstill.
Okay, Amory, we will track that. Amory Hordern tracking the geopolitical situation between Israel, Hamas, and the rest of the world. Now, the world's largest independent oil trader says they've elevated crude prices for the rest of the year. Vitol sees prices anywhere between $80 and $100 thanks to strong demand growth. Goldman also step in. They have a similar call on Sunday. Joining me now is Alex Steele on set to discuss this. So I knew it wasn't going to be too long before we get a Goldman Sachs note in my inbox about $100 oil. Now, that's not their base case scenario. Yes. But this is a constricting market with rising demand and supply outages. So the confluence is to the higher level.
Yep, and JP Morgan beat them to it. They had their not base case, but also potential bullish upside.
They're all just too frightened to put their base cases in.
It's true. But there are a couple things that could stand in the way of that. One, you get price destruction if you wind up having prices go too high, and clearly the Saudis are going to be really in tune with that. You also had JP Morgan in particular noting $4 gasoline here in the U.S. would definitely cut demand by upwards of, say, 200,000 barrels of oil a day. You also have it elsewhere, too, like diesel prices in Europe, for example. There could be the SPR release, that famous, wonderful SPR release thing, but you need more acts of Congress to release more than would be actually beneficial to the overall market, and demand might not make it. I mean, demand might peter out.
So let's just pivot then to, you know, who profits from I love commodity markets. It's where I started. And if you look at BP's numbers, and you look at Vitol's trading. Can you imagine being on the receiving end of the bonus out there in Vitol? So just talk us through the scale. I'm just thinking about the bonuses, but you take me through the more important.
No, I think the bonuses are totally legit. So this was the article that came out: is that Vitol, Trafigura, and Mercuria and Gunvor, so they're the really big independent traders, have a combined net profit of more than $50 billion in the past 2 years. If you compare that to 2018 to 2019, you're looking at just $6.8 billion. That's an enormous amount of profit. That also helps BP. They had had a trading update today where it should be relatively in line and strong oil and gas trading unit. And you also have these guys getting into other stuff like power markets, metals. Vitol's going to go back into the metal market. They confirm that. It'll be a small part of their business, but they did wind up confirming it. Freight, they're also adding gas. A lot of other traders adding gas if they didn't have it. And I gotta say, talking my own book, but that's all an energy transition thing. Like you need all of this stuff if we're gonna electrify everything and decarbonize everything, and that's what these traders are really gonna get into.
But then this is also about where we're going to have a carbon credits market. This is part of the ESG. This is part of COP. So it is about the evolution of these markets. We've always had power markets. We've always had carbon markets, but it's about the next transition of these markets, the next evolution of these markets.
Well, and it's also these guys getting into those markets in a more meaningful way, and then in how they're going to wind up structuring that, particularly when it comes to power. Just power here in the U.S., we haven't seen power growth in like 20 years, and now power demand is going to skyrocket, and it is the data center, and it is the AI, but it's also just regular people, too. So it's a combination of all of that. It's just like off to the races.
And this goes back, there was an oil company, shall remain nameless, which was here with me visiting, and they were making the point, the power usage in the United States relative to that in Europe. They see an exponential growth potential in Europe relative to the US, which is already, as you say, shifting into a higher gear. Great work. To be a trader at Vitol. Russell, pay them generously. Russell Hardy's the CEO there. Alex Steele on the energy markets. Coming up, you have your morning calls a little bit later. Schwab's Liz and Saunders joins me around the opening bell, making the case for more volatility in markets. The conversation to come in just a moment on Bloomberg.
Names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Skating on the edge of a bid as we go towards the CPI for tomorrow. Bond markets have taken a small breather. That gives these equity markets just a moment of relief. Nasdaq up 0.5%, but there's no standout stock that can define the narrative on the upside this morning. You got Tesla up 1/3%. This is what the Wall Street scribes are writing about this morning. Goldman Sachs upgrades Molson Coors to a buy, expecting the beer maker to outperform given historic seasonal trends. Barclays downgrades American Express to equal weight, warning of limited upside due to slowing revenue growth. And finally, you've got JP Morgan upgrading American Eagle to overweight. What they're pointing to is conservative sales estimates, and recent growth initiatives should underpin the stock. Coming up, Schwab's Liz and Saunders joins me to make the case for extended bouts of volatility. Get ready for that. She reveals her outlook. That's next. and the opening bell is up.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but you know, it is.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Points lower, but hardly what you call significantly lower. We are one hot CPI print away from a dereliction of the bulls in this bond market. Dollar yen flat at the moment, but of course we've had utterances from not just the finance minister about watching the developments in the FX market, and the Bank of Japan governor talking about the lack of desirability in FX moves, unched in oil. We gave a little bit back yesterday, nearly 1% down. Goldman Sachs are talking about the risk of $100 oil, as well as that Vitol also talking about oil in the range $80 to $100 on the upside. But we're back to stocks. You remember BlackBerry used to have one of those. The software company announcing robotics collaboration with AMD. Rejuvenation from a bygone era. Abby.
A rejuvenation indeed, and the stock is responding well, up 8.3% at this point. It had been on pace for the best day in about 2 weeks. Now the best day in about a month, so investors are liking this, and it is interesting that BlackBerry still is around, a security software company, and their description also includes AI, so I'm curious to see whether or not we'll be hearing more and more about BlackBerry as time goes on. But to your point, they have announced this collaboration with AMD right now, so that's a good connection right there. They, of course, the hot chip company, but also with the AI connection. And they're focused on the robotics industry to provide real-time performance, precision, reliability, and scalability. The company is saying that the combination enables sensor fusion, high-performance data processing, real-time control, industrial networking, and reduced latency in robotic applications. I'm so excited about what all of this will mean in the future. Can't even get my words out. As for the stock and growth, that is probably what they're trying to juice. Growth is somewhat flat for BlackBerry. The stock over the last year, Manus, into today, down more than 36%, but eating into that a little bit. And there is, of course, an 8% short interest. So some of this is probably a squeeze.
Okay, Abby, thank you very much. Let's turn our attention to the cannabis industry. Tilray falling, I should say, after cutting their full-year guidance, as well as missing the third quarter revenue. Alex Semenova is with me on the numbers, down 14% and change on Tilray.
Good morning, Manus. That disappointing guidance, that revenue miss were among the woes in Tilray's earnings that sent shares down as much as 19% this morning into the open. That is the biggest decline since May 2023. The company reported revenue for the fiscal third quarter that failed to meet estimates. It also cut its full-year adjusted EBITDA outlook below analyst expectations. Tilray now sees adjusted EBITDA from 60 to 63 million. That's well below the 68 to 78 million the company previously saw. Revenue did rise 29% to 188.34 million from the year-ago quarter, increasing both in its beverage alcohol business and in its cannabis business, but it fell short of analysts, the 198.3 million analysts had expected. Additionally, the company said that it no longer expects to generate positive adjusted free cash flow for the full fiscal year due to delayed timing to collect cash on various asset sales. Tilray said that its U.S. cannabis strategy is, quote, in place to strike if the U.S. reforms drug policy. The stock was up around 13% year to date through yesterday's close, as the Biden administration has shown signs of support for marijuana reforms. Manus.
Okay, thank you very much, Alex Semenova there. Now, it's two different stories for two different banks. Wells Fargo downgraded by Compass Point, while First Horizon receives an upgrade on the bank's trajectory. Simone Foxman has the latest. So where do we fall on this?
Yeah, Manus, analysts staking their claim here ahead of earnings season for banks, which kicks off on Friday. We've talked a lot about JP Morgan, Citi, but Wells Fargo also reports that day it's currently flirting with its highest level since early 2022 and up about 17% year to date. But Compass Point analyst David Rochester, he's just downgraded Wells Fargo to neutral from buy. He says although he sees a bunch of key potential positives this year, including regulatory wins, stronger buyback activity, and higher for longer rates would help Wells Fargo, he says the valuation is already baked in, but he keeps his price target of $64 a share, a little higher than we're trading right now. On the regionals, though, a lot of attention is going to be focused there because remember what was happening last year, the collapse of Silicon Valley Bank, and there are tough comparables, but the picture has brightened, and that is the case for First Horizon. It's among the better performing regional banks, up 7% year to date after falling 42% last year. RBC analyst John Arfstrom is upgrading that stock to outperform on increased confidence in near to medium term trajectory. He thinks we'll get to $18 a share as net interest income and fee revenue improve. Lower rates also would help First Horizon. We shall see. Get some verdicts starting on Friday, Manus.
Yeah, well, a year ago we convulsed over some of those regional banks, didn't we, Simone? And then there were the calls for recession, which we've escaped. Simone Foxman, the very latest on the banks. Turning our attention to funds. The Destiny Tech 100, a closed-end fund, has surged over 9 times its value in just a couple of days. Who better to tell us this story? Why? It is Katie Greifeld. Katie.
Manus, this is a really fun one. Like you said, this is a publicly traded closed-end fund that invests in private tech companies. Its target portfolio is 100 companies, but currently it only holds about 23 companies, with its top holding being SpaceX, of course, Elon Musk's rocket company. That currently has a 34.6% weighting in the portfolio, and it's followed by the likes of Axiom Space, Boom Supersonic, and Epic Games. Now, that's already fun, but the really fun part is watching the stock. It began trading in late March. It's up literally 1,000% since then, even with the drawdown today. Currently has a market cap of about $1 billion. And that raises some really interesting questions for Destiny. So it computes its net asset value quarterly. Its most recent calculation lists the net asset value per share at about $4.84. But as you can see, currently shares are trading above $80. So we're talking about a huge premium there. It's going to be really fascinating to see how this story develops.
It's like a moonshot stock, but it sounds pretty cool. Katie, thank you very much. Katie Greifeld there. So the bond market is in a mini recovery mode as we count down to the CPI. Keith Lerner of Truist writes this. Market participation broadened significantly, with the economically sensitive sectors such as industrials and financials making all-time highs alongside the mid-caps and the S&P Equal Weight Index. And that was the first 3 months of the year. Joining me now is Liz Ann Saunders, my guest this morning. So we've had this broadening in the markets. It's been a theme that we've touched on quite a bit. How significant has the participation been in that breadth in the markets? Liz Ann, good morning.
Good morning. It has improved. One way to think about that, not in traditional breadth terms of things like moving averages, but over the past year, only 11% of the constituents of the S&P have outperformed the index itself. But over the past month, that's closer to 50%. So it still probably could be and should be higher, but that's a significant improvement as you think about the concentration that was so evident last year and much broader participation, not to mention the shift in leadership away from many of those mega cap techie kind of names to more traditional cyclicals like energy and financials and materials.
Are we at the beginning of something much more significant? I'm looking at some of the news flow from the FT conference. VTOL, Russell Hardy talking about $80 to $100 in oil and a shift in the commodity cycle. Goldman's talking about the risk of $100 oil, and I've got Bank of America banging into the inbox this morning with gold at $3,000. How do you look at commodities? How do you participate in, obviously, what is some kind of a shift for a whole variety of reasons in commodities?
Yeah, I think the fundamentals behind it, aside from things like, momentum just feeds on itself and you generate enthusiasm, certainly on the part of retail investors. But I also think it may reflect some sign of improvement in the global growth outlook. There's obviously also the supply-demand fundamentals, especially as it relates to oil with production cuts in the case of Russia. And so I think it's just a story that has been to the benefit of not just commodities, but traditional equity sectors like materials, which is a play on that. Now, it's also been a boost to headline inflation metrics, including headline CPI, that obviously could continue to be a feeder. And even though core is ex food and energy, if you look at the relationship historically between even whether it's core CPI or core PCE, and then the commodity complex, there is a feeder there. There's both an actual feeder and a psychological feeder. So that's something to be mindful of, especially a day ahead of tomorrow's important CPI report.
And we're counting down to that CPI report. The bond market takes a breath this morning, doesn't it? But it's been a pretty ferocious run up in this bond market over the past 6 trading sessions. How concerned are you that this CPI could be a significant dislocator? I mean, we're looking for a drop on the core to 0.3%, but we're still looking at quite a chunky year-on-year figure.
I think for both CPI and PPI, yes, I think they could be market moving, especially if they're outside the range of consensus. But what I think is important now is how the readings, the combination of CPI and PPI, map to PCE, because that is the Fed's focus. PCE has been running lower both at the headline level and the core level to the tune of about 80 basis points or so. So I think the real calculus is about economists taking a look at the combination of CPI and PPI and figuring out how that feeds into the next PCE report, not just at the headline and core level, but also core services ex housing, which has been that specific metric that the Fed has focused on.
Do you think clients have a temptation at these kind of yields, these kind of headline yields, I should say, rather than yield to maturity in bonds? Is there a certain amount of temptation to step in and pick up coupon and duration?
Well, we've actually, and you know, my colleague Kathy Jones is our fixed income strategist. You have her on your air quite a bit, and have encouraged, you know, lengthening duration so that you are locking in these higher yields, even if they look still slightly less attractive relative to much shorter duration yields. You don't have that you know, rollover risk. So there is a benefit to locking in that longer duration, but obviously decisions as it relates to where to be on the duration spectrum is very individual specific, depending on your needs for income and time horizon, et cetera.
Now, in part of the narrative that you put out there, you look at the revisions to GDP and you normally say, look, normally you don't have to pay too much attention to that. And I like the line which was au contraire, and you talk about the upward revision in the personal spending space. And that suggests the consumer still remains strong, still remains robust. What does that mean from an equity perspective?
Well, yeah, the consumer has been a big driver of the economy and very robust, and that sort of flies in the face of what traditional fundamentals around things like the savings rate might suggest. But what I think it's driven by is the strength in the labor market, both in actual terms and psychological terms, but also, you know, the net worth gains, which, you know, obviously it leans more toward the upper income end of the spectrum. But since last October, we've had about $13 trillion of net worth added to U.S. individuals. And to put that in the context of consumer spending is about $19 trillion. So that's a huge increase. But we are starting to see shifts as it relates to inflation and the hits. And, you know, I think you have to now focus on not just nominal data, but real data, and shifts in terms of the preferences on the part of individuals, what's happening down the income spectrum, and increased use of credit cards and delinquencies picking up there. And that to some degree has been reflected in how equities have behaved too, is that sort of fine-tooth comb analysis that is necessary to see what's really going on under the surface of things like headline reports and index gains.
Yeah. It is that differential, isn't it, between the sort of the upper income levels perhaps and the lower income levels having a tougher time, and then we have the small businesses confidence they're coming in at an 11-year low. So it is the nuances. Lizanne, thank you very much. Lizanne Saunders of Charles Schwab, my guest this morning on the equity markets. Coming up, Boeing delivery, despite its troubles, can they?
Without an absolute reputation for safety and consistency, you simply can't compete. And that's why everybody's worried about Boeing. We've got to get Boeing back to the point where it produces an impeccable product.
The conversation next on Bloomberg.
As Linda Amin tells the story of Asia's rise through the people who are helping to shape it. This week, navigating the challenges of AI, shifting generations, and talent retention, Recruit Holdings CEO Hisaoki Idekoba opens up about the future of employment in Japan and around the world.
More workers don't want to do tough jobs. They prefer to have remote work or flexibility.
Latitude, encore presentation this weekend, only on Bloomberg.
we're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
Let me just start with, this is not the first time we've heard this argument.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
You're looking at Airbus and Boeing as to purchasing airplanes. What you try to do is you try to find the best quality, the best price, the best operating costs, without an absolute reputation for safety and consistency. You simply can't compete, and that's why everybody's worried about Boeing. We've got to get Boeing back to the point where it produces an impeccable product.
Well, Boeing and Airbus both set to post their first quarter deliveries a little bit later today, and the analysts are anticipating to see cash flows from Boeing. Joining me now is our Boston Bureau Chief, Brooke Sutherland, on this story, and she also writes for Bloomberg's Industrial Strength newsletter. Brooke, how much of a crunch will the production slowdown be at Boeing? What's the scale of the production slowdown, first of all?
I think it's going to be pretty substantial. So what the FAA has done is it's capped Boeing's production rate at 38 a month, but they are not producing anywhere near that level. And I think, you're going to start to see the impact in the coming months of Boeing's effort to move away from traveled work. So what that means is in the past, they'd really put a priority on keeping those airplanes moving down the production line and keeping those gears of the factory turning. Instead, they're going to stop that, really focus on making sure that the plane has all of the parts it needs and quality is where it needs to be before it moves on to that next step. But of course, in the interim, that does weigh on deliveries.
And in terms of when the FAA take the cap off, remove the cap, just give me a sense of how quickly they can retain or re-ascertain those production levels. Because at the moment, they've got to go for quality, real quality relative to where they were. And that ultimately has a cost.
I don't think the FAA is in any rush to lift that cap. And so what they've said is that that cap is in place until they feel satisfied with Boeing's quality control procedures. Now, they separately did an audit of Boeing's production lines, cited multiple instances of manufacturing lapses. So I think there's a lot of work that needs to be done on the Boeing factory floor before the FAA feels comfortable to even talk about moving away from that cap on the production rate. But to your point, absolutely. I mean, I don't think that this is, once the FAA does give Boeing the green light, they can just snap their fingers fingers and start producing planes at a higher rate. Like I said, they're not anywhere near close to that cap right now because they are focusing on safety, but you also still do have supply chain issues in aerospace. This is the one corner of the economy where we are still seeing parts shortages, labor shortages, a whole series of different factors that are impacting companies' ability to produce the parts that they're supposed to. And this is not just a Boeing problem. GE has talked about 80% of its delivery challenges are rooted in its supply chain. So this is across the whole aerospace and defense ecosystem, and that also is a gating factor in terms of how many airplanes both Boeing and Airbus can ultimately produce.
Now, look, it's been a couple of weeks since Boeing announced Calhoun was going to go at the end of the year. This is a company essentially in strategic limbo. And I just want to get a sense of to what extent that holds this company back from delivering on the requirements of the FAA and then getting back to some kind of quality, uplifted quality norm.
I don't think it's helpful to have this period of limbo, to your point, but I also think that they don't have the right candidate yet signed up to replace Calhoun. So on the one hand, you would want them to find that person, and introducing another figure right now is just going to add to the uncertainty. So I do think, Boeing has every reason, and I think they are finally taking this seriously, to get to the bottom of their quality control issues and make sure that they can reassure their customers that they can actually deliver the planes that they have promised. And so I think they have every incentive to figure this out, no matter who is in the CEO role. But there is, they do need to take the time to get this right. They need somebody in that job who is going to actually solve the problems, because Calhoun was brought in to solve a crisis when the two 737 MAX jets had crashed, and Boeing is still dealing with many of the same problems. And so I think if you're an investor or a Boeing customer, you want them to really take the time to find the right person to lead this company into the future.
Brooke, thank you very much. That's Brooke Sutherland. We'll wait for those numbers from Boeing. We'll bring those to you as soon as they cross the Bloomberg terminal. Sector price action for you this morning. Abby's with me.
Well, Manus, we're looking at a very small gain for the S&P 500 right now, up about 0.1%. Now, interestingly, it is a broad-based gain, lots of sectors higher, but not up by much, and that is basically why it's such a small gain. Up top, real estate up 0.5%, despite the fact that you have yields down, which would typically, actually, that does make sense in terms of dividends of real estate looking more attractive. Plus, yesterday's big deal, $10 billion deal, Blackstone buying that apartment REIT. To the downside, financials, industrials, consumer staples. Now, what's interesting, though, we may have financials down 0.3% ahead of the big banks reporting on Friday, Menace. However, some of the big banks, I should say, the regional banking index, that ETF, and in this case, index, up 1.8% over the last 2 days. So some of those small cap banks getting a bit of a bid.
Okay, Abby, thank you very much. Coming up in the show, market moving events to set your watch by. It is your trading diary on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal?
The Deal?
The Deal. The Deal.
That deal.
The Deal.
huge deal.
Who dug this up? What are y'all in trouble?
Wow. Of basis points down on bonds really enough to give succor to the equity market? Well, if that's the narrative you want to play out, please do. You've got stocks holding on to their gains. This is ahead of the CPI. We're expecting 0.3% of a number on the core. We've got 24 hours to run, less than 24 hours to run on that. Right now, there's a resilience in stocks. Your trading diary looks a little bit like this. Treasury auction is coming. $58 billion of 3-year notes at 1 p.m. Eastern. Wednesday, it's another big day for CPI. The report in America, as I say, will come out. And you have PPI and initial jobless claims hitting the tape on Thursday. Follow through, you have an ECB decision, and that differential between the ECB and the Fed is going to become ever more apparent. Mohamed El-Arian's discussion on surveillance this morning is relevant on that. Bank earnings hit the tape on Friday. JP Morgan, Wells Fargo, and Citi all deliver their results. We're counting down to these auctions at the short end, and indeed longer dated paper as we go through on the week. Threes today, $39 billion of 10s tomorrow, and $22 billion of 30-year paper coming through on Thursday. That was countdown to the open. We're nervous ahead of CPI. This is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Hopefully we all survive the eclipse. We are back here. Futures are mixed out there. Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. This is the Bloomberg Intelligence Program. We focus on companies, we focus on stocks and bonds and all that kind of good stuff. And we lean heavily on our good friends over at Bloomberg Intelligence, or BI. To the insiders is Bloomberg's in-house investment research department, 400 professionals covering more than 2,000 companies, 130 industries all over the world, and we lean heavily on those folks as we do. David Havens from BI is going to talk to us about Blackstone, and they're making some deals out there on the M&A front. Ira Jersey, Bloomberg Intelligence rate strategies, are going to help us preview the inflation data we're going to get later on this week and maybe how the Fed might react. So we got a lot coming up. But first, let's check in with Mr. John Tucker, get a Bloomberg Business Watch.
All right, Paul and Alice, the major stock averages, they are mixed, a little change ahead of the CPI tomorrow. 9 of the 11 major industry groups in the S&P 500 higher right now. Real estate, that's in the lead. The biggest drag that's coming from the financials. Of course, the banks start reporting earnings on Friday. And after that recent surge, the Treasury yields today, they are pulling back. In the meantime, the path ahead for stocks probably higher, at least according to Sarah Hunt at Alpine Woods Capital Investors.
There is a lot of different narratives that keep switching back and forth, and at the moment we're in a very positive one, which is that the Fed can cut rates, but it's into a strong economy, and things are going fairly well. So I think that's the current narrative that we're seeing today.
And among the individual shares, one of the standouts, Tilray Brands, those shares sliding 18%. The cannabis company cutting its full-year adjusted outlook below analyst estimates. Those shares right now down again 18%. Overall, the S&P 500 4 points higher at 5206. The Dow Jones Industrial Average down 59 points. The NASDAQ 100 right now up 65 points. As for those yields, the 2-year 4 basis points lower, right now at 4.74. The 10-year yield, that is down 4 basis points. That is at 4.37. And we check the markets for you all day long right here on Bloomberg Radio. We're brought to you by Interactive Brokers Bond Marketplace. Access their vast selection and over 1 million global fixed income securities with no markups or built-in spreads and low, transparent commissions. Learn more at ibkr.com/bonds. I'm John Tucker. Now back to Paul and Alex.
All right, I did see part of the eclipse.
Okay.
It was cool.
It was cool.
It's
cool.
very cool.
I saw it at 2:15, 2:30 because then I had to go on TV. But even seeing like a little bit of the moon over the sun, like that was pretty awesome.
And the glasses worked.
The glasses worked, although afterwards I was like, is my right eye okay? Like I started to feel like it was hot, and everyone's like, you're just fine. My daughter, though, was like, meh.
Really?
I know, right?
She's a chip off the old block.
I mean, Debbie Downer over there. I was like, how was it? She's like, yeah, it was all right. And then apparently they went back to the playground. Did you guys see it? How was your welding helmet, John?
I put the welding helmet on, and it worked perfectly. The only problem was it's been in the shed for I don't know how many years. And I put it on my head, and apparently there were a bunch of spiders nesting in there. So as I'm watching it, it's like they came out. I got attacked by spiders, but it was still pretty cool.
I don't know. That does tracks. That tracks for me,
that
for
does.
you.
Yeah. That he has a shed in the back. Great. Glasses worked fantastic. Great view from the Jersey Shore. Lisa Mateo was saying up in North Jersey it was a little too cloudy, but down the shore it was very nice.
That's tough.
And as soon as it occurred, my power went out.
Oh,
really?
Very interesting.
No idea if there's no connection there.
There's something happening with John Tucker right now.
Yeah.
The spiders, the power out. Watch out for locusts and frogs. Just saying.
A little dark cloud.
Yeah. All right. So we're looking at the market here. It does feel like let's just wait till Wednesday.
Yep.
Check you tomorrow at 8:30. A buy everything kind of day except for the dollar. Norma Linda joins us from Bloomberg News to walk through what she is looking at. What's on your docket right now?
I mean, I'm still looking at apartment REITs. I mean, they are really some of the top gainers in the S&P 500 right now. I actually wrote a story yesterday coming off of that news about Blackstone placing its bet on apartment REITs, and we are seeing that index. That's BBREAPT. up about 1.2% this morning, and a lot of these companies are really coming higher with it. We have a Mid-America apartment communities higher. That's the biggest gainer in that index. But as John just earlier mentioned, we've got real estate as the biggest or the best performing sector right now in the S&P 500 this morning.
I mean, again, as I've been told by the experts, not all real estate is created equal. I mean,
Not at all.
The multifamily, fine. If you want to buy a warehouse, good luck. If you want to buy, you know, a healthcare office park, great stuff there. If you want to buy an office tower in the middle of an urban market, maybe not the best deal here.
Maybe not too much.
Yeah. So, but I mean, and Blackstone, I mean, we're going to talk to David Havens from Bloomberg Intelligence coming up on some of these Blackstone deals. But Blackstone, you know, institutionally, not knowing the space, it's got to be one of the biggest institutional owners of real estate in the planet. You know,
Definitely.
so
Huge.
They kind of know what they're
Such
doing
a huge
over there.
Footprint.
Yeah, they know what they're doing.
Oh, what else are you looking at?
I'm also looking at Norfolk Southern. So when you look at those shares, they are up 1.2% this morning. And this is coming after the company said that it would pay $600 million to settle a spill case. And this is after it had a train that derailed in Ohio last year, making it spill more than 1 million gallons of toxic chemicals. And this, of course, sickened a lot of the residents there. But this is really obviously putting a bit of a pop on that stock as they are settling on that case.
Yeah, and look, the stock, it's a stock I covered way back in the day.
You did?
Throwback.
Yeah.
Oh, interesting.
My
Tell me more.
first, I covered the rails and trucks, and we wrote the definitive report on the first, what was then the biggest IPO of all time, the Consolidated Railroad, the old Conrail stuff the government was selling. But anyway, Norfolk Southern is, you know, my images of Norfolk Southern when I worked down in Richmond had my office overlooked a railroad and the James River, and these Norfolk Southern trains loaded with coal from West Virginia going right to the port in Newport News for export coal. And they would do like 3 or 4 trains a day every single day. So, but no, that was a bad accident there earlier. But again, the market was, I think, discounting maybe even a bigger number perhaps. So the stock's up a little bit today.
All right, and you think everything else is going to be calm until tomorrow at 8:30? Or are we overhyping
surely hope
8:30
so.
tomorrow?
I mean, I think it's funny because my team, the stocks team, we're really sitting here preparing. We're like, you know, we need to call all the portfolio managers in the morning, see what's going on.
You're bracing.
We are bracing, just like the rest of the market.
Right, it feels like we're definitely set up for disappointment on that one. All right, Nora, thanks a lot. Really appreciate Nora Melinda joining us. She'll be back at the top of the next hour. So, L'Occitane for Paul